Let's get to some earnings now because Amazon's fourth quarter results are just hitting the wire. You can see we're dropping initially here a quick 8%. Q4 EPS, $1.95. The street was at $1.96. It looks like Q4 net sales, I see $213.39 billion. The estimate was $211.49 billion. Q4 AWS net sales, XFX, up 24%. The estimate was 21%. Just to break that out, it looks like that was $35.58 billion. The street was at $34.88 billion. Q4 operating margins, 11.7%. That looks smack in line with what the street was looking for. I'm looking for Q3 North American net sales. There it is, $127.08 billion. I'm looking for consensus was $127.08 billion. Now let's spin ahead. Q1 net sales, they're guiding for between $173.5 billion and $178.5 billion. The street was at $175.54 billion. And now, of course, we want to look for that CapEx number. 2026 forecast for CapEx. Amazon is saying about $200 billion. The estimate was more like $146.1 billion. That, I think, helps explain this quick move lower, 9%. Remember, heading into this print, this stock had already been under pressure over the past 12 months. It was actually in the red. It was down about 5%. Now, some on the street had argued, including on this show, that was an opportunity, they said, because that was simply a more attractive setup into the report, that it was trading at a big discount to peers. They like what they see with AWS. Marking return to the AI game. They believe the consumer would remain resilient. That CapEx number, though, $200 billion, is going to get a lot of attention. Remember, yesterday, Alphabet certainly made headlines. They gave a CapEx forecast as much as $185 billion. So that's getting attention. Right now, heading into this print, the stock was down over the past 4 months. We're down now nearly 11% here in the after hours, despite the fact that the bullishness on the street for this name is impressive. You've got about 95% of analysts who are paid to tell you what to do with the stock who say Amazon is a buy. So remarkably bullish on the street, but at least initially here, investors have some real questions about this report and the guidance. We got that CapEx guide. Arun, we're talking about $200 billion. It's a number that's hard, I think, to get your head around, Arun. You got a strong buy on this name. We're down here a quick 10% in the after hours. Give me your take, Arun, your first impressions on the print and the forecast.
Yeah, thanks for having me. Yeah, no, I mean, overall, I think the one big positive here is that AWS acceleration. You know, we wanted to see acceleration. We got that last quarter. We saw further acceleration this quarter. We got 24%. I think the street was looking for around 21, 22%. So that was a big highlight there. Yeah, I think the shares are down because of that CapEx number. We were estimating around $140 billion in CapEx this year. It looks like it's going to be around $200 billion. That's much higher than our estimate, much higher than street estimates. But given what Google said last night, it shouldn't be that much of a surprise that the CapEx figure is above consensus. But yeah, $200 billion is quite a lot. I think it's about a 50% increase from 2025, and 2025 was about a 60% increase from 2024. So some significant spending ahead. But clearly, I think Amazon is still seeing more demand than it has available supply, and that's why we're seeing them, not just Amazon, but all the hyperscalers invest so aggressively to capture all this AI demand.
Dan, I want to bring in you here. Let's stick on that same thing and let's remind viewers. Amazon is calling for 2026 CapEx of about $200 billion. To Arun's point, that is far above what analysts had penciled in. Consensus was more like $146 billion. I think investors look at that, Dan, they say, okay, I want to know, I'm going to get some very strong ROI on all that spend looking ahead. Are you certain you'll get that, Dan?
I'm incredibly certain that that's coming. Look, these are very smart companies that have very good data, very good analytics, very good understanding of their demand. And basically, Josh, every CapEx estimate that's come from analysts over the last few years has underestimated what is required. Right now, Google, Microsoft, Amazon, Meta, they are all competing for the most compute. The compute is going to be the moat in terms of these companies being able to sustain their market advantages over the long term. Each of these companies understands that if they don't have enough compute, they will not be able to pivot quickly enough to the next thing. We're watching how fast new models, new services, new capabilities are hitting with AI. And of course, all of these companies are also servicing the demand of all their customers that need and want more and more compute. I saw Matt Garman this week at the Cisco AI Summit, and I listened to him talk about how the A100, that's like a 4 generation old GPU from NVIDIA, is still at 100% demand. They have not decommissioned any, and they have not seen demand go down, and they've seen the spot prices continue to go up. So the demand for this stuff remains high. These companies need it for their moats, and Amazon got it wrong in the beginning. They underspent. They understand they cannot do that again. And the street is being maybe rational in some short-term perspective of how much these companies should spend, but they're being irrational long-term if they want to see Amazon continue to do what it does and protect its moat.
So Arun, as a financial analyst then, you're looking at, all right, this call for $200 billion. What are the signs? What are the signals? What are the metrics, Arun, you're going to watch to see whether this is money that's being well spent?
Well, I mean, first and foremost, we're going to need to see AWS growth further accelerate. I think now, given that they've spent a significant amount this past year, now $200 billion in 2026, street estimates for AWS growth is probably going to increase for 2026. That's number one. Number two, we're going to look at the AWS margin line, to really see if that they're getting that ROI, and that near term there are some headwinds to margins when you're significantly ramping spending like that. But so far AWS margins have been pretty solid. I don't have it for this latest quarter, but it's been hovering around the mid 30% range, which is still pretty solid numbers. And over time, that AWS margin line could go above 40%. So we'll look to see if that how they can preserve that margin line at AWS for 2026.
Dan, I got to ask you, if I'm an investor, I'm watching this, tech pro that you are, I just heard Alphabet, all right? I just heard Sundar Pichai tell me he's going to spend as much as $185 billion. Now I got Jassy telling me about $200 billion. If I'm an investor, who downstream from this, Dan, benefits? Should I be am I looking at NVIDIA? Am I looking at Hock Tan and his crew over at Broadcom, Dan? What do you see?
Look, every part of the silicon supply chain is constrained. And right now, this should be sending signals like, right, if you want to penalize the hyperscalers for their near-term spending because you're concerned about margin pressures and you're concerned about the potential impact to their business, that's one thing. But you can tell there's some indiscriminate selling going on. Now, I think some of the semiconductors held up a little better today, but if you look at this CapEx commit, if you look at Sundar, you look at Satya, you look at Andy here, all of them are basically saying we're going to be spending big on NVIDIA. Of course, they're going to be building their own silicon, so that's great for Broadcom. I talked to Lip Bhutan the other day. He and I had an agreement on the memory. We're talking 28, 29 before those constraints lift. So Sanjay Mehrotra and the team over at Micron should be feeling very optimistic, as well as the rest of the memory, ecosystem. And then, of course, you have all the other parts, the packaging, the semiconductor equipment manufacturers, TSMC. I mean, you saw their numbers in their guide. There really is no slowdown in the spending. This is definitely an indication that the market wants to hear more clarity on where the ROI is going to come from. But clearly, these companies don't care. What they care about is they do not want to be outbuilt. And Amazon, Josh, and I'll leave you here on this, but Amazon knows this better than any, because Adam Selipsky's job was basically to get this right when he didn't get enough NVIDIA into AWS early enough. I think that's what ended up costing him his job. I think the fact they've been able to stand up Rainier, expand their capacity, and accelerate their growth to 24%, because they're facing 39% from Azure, 47, 48% from Google. They have to grow faster. They need more capacity. They have to spend.
Arun, you don't just have a buy on this name. You got a strong buy, my friend. You got a pound the table buy. When your clients ask you, Arun, okay, you're bulled up on this name, but what are the risks I need to think about, Arun? What were you telling them?
Yeah, I mean, the risk is really the elevated street consensus forecast. There are high forecasts here, and Amazon has to hit them every single quarter. I think Amazon also, they kind of shoot themselves in the foot a little bit because they report typically last out of all the hyperscalers, so sometimes a little bit more expectation there. But we still have a strong buy rating. Amazon, we talk a lot about AWS today, but both their retail business as well as their advertising business are both also firing on all cylinders here. And I think the best, the strong buy opinion is really predicated on Amazon's margin trajectory. Its highest margin businesses, namely its advertising business, AWS, is growing at a much faster rate than the e-commerce or retail side of the business. So that I think, over the long term, over the next 5 to 10 years, we could see some significant operating margin expansion at Amazon, and they're close. I think within 5 to 10 years, they're gonna be above $1 trillion in annual revenue as well. So that's some significant earnings potential for this company that we still think trades at a relatively low or attractive valuation.
Dan, in the great AI trade and trend, there is this perception that Amazon is playing catch up, that it's chasing rivals, Dan, like an Alphabet. Is that perception fair, Dan, in your opinion? Is it accurate?
I think early on, and that's what I was talking about. I think they came out a little slow. They were leaning on their own infrastructure early before it was ready. They've made a ton of progress with Trainium. I think, of course, we're seeing this surging demand, and they got their NVIDIA capacity, scaled up. So they're moving in the right direction. We certainly saw a pivot in Cloud Era 1.0. Amazon, AWS was the largest by far. In Cloud Era 2, you can argue Azure, and especially Google Cloud has been able to really build its own infrastructure. It's spent a decade on building capacity models, chips, and so I think they're playing catch up, but I think they're showing now the positivity of that massive base of business they had from the first compute era. As all these enterprises that rely on AWS are now starting to move to AI capabilities in AWS's cloud. This number's good. I mean, 24% from a very large base. Now, having said that, the expectations remain very high. And I will also say that Amazon is probably one of the largest potential beneficiaries of AI within their own business, and not just their cloud business, their advertising business, just like Meta takes advantage of, and of course their commerce business. They have robotics, they have physical AI at the edge, they have autonomous delivery. They have so much opportunity to pull margin out of that near $1 trillion of revenue we're going to see from them in the future, that I think that's part of the story that's being missed. And finally, for all the boomers out there that are rotating into consumer staples and nervily moving out of tech, they've got a great play, because who doesn't have Amazon delivering at their door just about every day?
Dan, Arun, so good to have both you guys on the show today. Appreciate that instant analysis, fellas. Thank you.
I mean, I'm getting tired of saying the CapEx number was higher than we expected, Rohit. Like, you guys all on the street, I guess do you just have to raise all your CapEx forecasts at least a quarter or even a half, right, going forward? Is that what needs to happen?
Yeah, I think this entire cycle of surprises of, okay, capex is higher than expected, has been going on for far too long. As in, I think the companies also are putting the next kind of threshold slightly ahead of what the street was expecting. So that environment of negative surprises, and for a company like Amazon that has just far too many surfaces of risk, be it commerce, cloud, ads, and so many other parts of the business, that creates a series of yellow flags, if you will. I think, but you're spot on, Julie. I think we all sell-side analysts should just decide that, put the capex number so high, so next time all we need to do is lower those numbers. But that's, in all seriousness, I think what Amazon is doing is investing from a position of strength, and we like it. We think you just need to be patient to appreciate this Gen AI winner, in my opinion.
And in the case of Amazon, ROI is like the mantra right now, return on investment. So in the case of Amazon, walk me through what that looks like.
Return on investment should ideally show up in all three parts of the business. Right now, the return on investment is showing up in the cloud, AWS side, where last 3 quarters, growth rate has gone from mid-teens to almost mid-20%. And we see the next couple of quarters that mid-20% growth rate to probably go even higher, given what CapEx has done. So that checks the box very well. That's in line with what Google has demonstrated recently. So we like that. But remember, Amazon is one of the world's largest retailers, one of the world's largest ad companies and media companies. So I think for that to demonstrate some accelerating growth or some direct linear ROI probably takes more time and more money. And that's where this $200 billion capex number comes in, that it's a much bigger business, much more diversified business, and hence more money and more time is required. So to get to your question directly, Julie, I think we need e-commerce growth to go solid double digits. It's been between 8 and 11% over the last year and a half. If AI is actually demonstrating ROI for Amazon, I think we need e-commerce and ads both to grow solid double digits.
Well, what does AI do for the e-commerce side really at this point, Rohit? And how much can it do if consumers, particularly lower end consumers, are challenged?
I think the way we see AI help large companies like Amazon in the e-commerce side is, again, you may or may not have used their AI chatbot called as Rufus. There is that that can help people find the product that they're looking for a lot quicker than what otherwise you would have had to search through, sort through, filter through a whole bunch of search results. So that conversion from a discovery to actually finding to checking out a product, that entire funnel that Amazon has over the last 10 years very fine-tuned to a normal checkout flow, AI can make it a lot faster. So again, I believe we are in a very early inning with that manifesting in Amazon's numbers, but the way it would manifest is more units sold. So for example, in Q4, the number of units sold were accelerated a slight bit. Again, they sell millions of units every day, and so that acceleration is commendable, but we need more. So I think those results, those kinds of tidbits in the next couple of quarters will give people confidence that, hey, you're spending on AI and it's showing in places that actually matter, like commerce and ads.
Rohit, gotta leave it there. Thank you so much for joining us. Really appreciate it.
Thank you.
Well, Alphabet fourth quarter earnings just crossing the wire here. Let's get you those results. Q4 operating income, $35.93 billion. The street was closer to $36.95 billion. Top line, $113.83 billion in revenue versus an estimate of $111.4 billion. I'm just looking for revenue ex-TAC. There it is, $97.23 billion. The street was at $95.17 billion. Ad revenue, that looks better than expected, $82.28 billion. The street was closer to $80.89 billion there. Looking for Google Cloud, there it is, where of course Google competes with Amazon and Microsoft. Google Cloud revenue, $17.66 billion. The estimate was actually $16.2 billion. And now for CapEx, they see 2026 CapEx. It looks like they're calling for between $175 to $185 billion. Per Bloomberg, the consensus on the street was more like closer to $120 billion. And that perhaps explains the reason we're seeing a quick move lower here in the after hours by about 6%. Remember, of course, expectations for this stock sky high heading into this print. I mean, this stock was up around 80% in just the past 6 months. Investors had decided this one was an AI winner. It was a remarkable change in the story for Google in that a year ago, if we were talking, all the talk was here comes Sam Altman, here comes OpenAI, and what that means in terms of Google search. Google hit right back with Gemini AI models with AI overviews, and investors piled in and rewarded them for that. But now we see a quick drawdown in the after hours, perhaps on that CapEx number. Again, they're calling for 2026 CapEx. Companies saying 175 to 185 billion. The street had modeled closer to about 120 billion. Well, joining me now is Ivanka Delevska, founder and CIO at Spear Invest, and Dan Flax, Neuberger Berman, senior research analyst. Welcome to you both. I'll start with you. The stock is at a quick roughly 5% in the after hours. What do you make of those results?
From what I heard, Josh, it's basically all about expectations. I think expectations were high going into the quarter, and you really had to exceed by a lot this quarter in order for the stocks to work. So the fact that they came in line to slightly lower in some metrics plus the higher CapEx, I think that's probably driving the stock. I think for us, search is an important data point. CapEx is important as it relates to the AI trade. We don't own Google, but we own a lot of the companies within the value chain. So I think the AI story is on track with those CapEx numbers that you just read.
Dan, I want to bring you in here as well. We're kind of yo-yoing here in the after hours. Looks like we're bouncing now down about 3%. Q4 revenue ex TAC, Dan, that looks like a beat. I mean, 97.23 billion. Consensus was more like 95 billion. But that 2026 capex number, Dan, 175 to 185, when the street was closer to 119.5. Perhaps explain some of the pressure here, down about 2%. What do you make of it?
I think the results were strong overall. Clearly, there's focus on the capex numbers and, of course, the operating income. But I think the search business is healthy. And really, this company is continuing to reinvent itself, reinventing search with AI, overviews AI mode. Clearly, there's a lot of momentum behind Gemini. And so I think the company is investing from a position of strength. We remain long-term owners of the stock, as you know, Josh. And what I see here is a company that really sees the opportunity to play offense. They have the balance sheet and the free cash flow generation to support the aggressive capex. And so we continue to like the name here.
You know, it's interesting, and now the stock is down about 1%. It's amazing, Dan, just the story, how it shifted here, the narrative it shifted. You know, if you were talking 12 months ago, Dan, you remember that. It was like the fear around this name, that OpenAI was coming, they were going to crush Google search, which of course, listen, that's the company's bread and butter. A remarkable turnaround, Dan. I mean, heading into this print, the stock was up about 80% in the past 6 months. What do you make of that turnaround? What do you make of that narrative shift?
I think it's being driven by the innovation, by the execution on the product cycles, really taking search to a new place. They're delivering value to users on one side with longer and more complex queries, and that creates value for the user. And then on the other side, they're creating value for the advertisers. And so I think the technology risk, and of course the market's very worried about disintermediation and disruption across the space. Google is demonstrating that even with fierce competition, they can navigate and in fact capitalize on the opportunities from generative AI. And so when I look out over the next several months, I think this push and pull will continue. But Google, in my view, is able and has the pieces from the silicon, the data, the models, the products, and of course the users to really seize this opportunity to drive strong growth.
You know, we battled right back to the flat line here now, Ivana. On this higher than expected 2026 capex forecast, Ivana, let's say you were on the call. What would you ask executives about that?
Well, the key is going to be where the investment's going into, whether it's in hardware, is it going to be building out their own TPUs? I think that's one interesting angle of this story. I think they're going to make some really good segue into that market. So the question is going to be, where is the capex going? We really like the infrastructure side of the AI trade. We see the most upside there. We think a lot of these big capex numbers are translating in really big numbers for the value chain. So that's really where we're focused on.
Dan, how about Google Cloud? Revenue 17.66 billion. That looks better than consensus. How do you see, what are the trends in that business, Dan, in the year ahead?
Josh, I think the Google Cloud opportunity is tremendous over the next few years. When we speak to customers, they get a lot of value from the Google offerings in areas like analytics as one example. And so this opportunity remains incredibly early. The company has been building it under Thomas Kurian and the leadership team. It's ramping. Margins have been improving in the last few years. And so I look at this opportunity and see a $100 billion revenue business over time. And I think the story here, when you take the cloud and you take YouTube and you take search, it's this broadening of the growth drivers. And I think the cloud opportunity provides a level of durability to the overall company, which is, I think, important from an investment perspective.
Ivana, a lot of investors pile into Google because they see this as a company with the full stack, meaning they got the chips, they got the cloud business Dan was just talking about, they got the massive distribution. Does Google almost sort of stand apart in that?
Absolutely. Yeah. I think they're really out of the mega caps. They're probably the best positioned one because they have the long-term moat that's backing up a lot of their businesses. So I would say absolutely they stand out on the full stack between the chips and the fact that they can easily monetize them even for their own use cases. I think that sets them apart. And they're able to basically offer the services for free where everybody else has to offer ads and other stuff into their products.
Dan, I know you like the stock, but after the run it's had, my friend, again, monster run, 80% in 6 months, Dan. Do you like it just as much here, Dan? How do you think about valuation at this point?
what we're looking for is the free cash flow generation over the next few years and really the growth rate of that free cash flow. We discussed the cloud business as one example where they've built an extraordinary franchise, which is actually very, very early. And I expect that as an example to generate a lot of free cash over the next few years. And so when I put the pieces together, I see a business that is likely to compound at double-digit rates for Alphabet as a whole. I think there's a lot of potential in newer areas, longer term, for example, with Waymo. And so the valuation, in my view, remains attractive here with a 1 to 2 year outlook, because I think there could be stronger growth than the market expects. And I also think the business mix is becoming stronger and more durable. And so the key is coming out of this period, Google, in my view, will be in even better shape than it is at the present day.
Ivana, Dan mentioned Waymo there. We should note, Bloomberg noted, just raised $16 billion at a $126 billion valuation. You're a longtime tech investor. How broadly excited are you about that space, autonomous driving?
Well, I think it's a very exciting space, George. The question is that we're still in very early innings. So I think we're still 5 to 10 years out from where we can really have autonomous cars deployed everywhere. And this goes along the lines with the robotics opportunity. I think both of them are very strong long-term opportunities, but there is really, the use cases that we see today are not really there to justify the next 2 to 3 years of return. So I think the application layer will be very interesting long-term, but it's going to come a little later in this cycle.
All right, Alphabet stock continue to yo-yo here a bit in the after hours. All eyes now, of course, on that conference call. Dan, Ivana, thank you so much both for your time. Appreciate it.
Alphabet, the Google parent, falling after saying it plans to nearly double its spending this year. The company reporting CapEx spend in the range of $175 billion to $185 billion. As CEO Sundar Pichai says, AI investments are driving revenue and growth across the board. Joining me now, John Blackledge, TD Cowen Managing Director and Senior Equity Research Analyst. So, John, what is the difference between a company that announces huge spending plans and the stock rises, and one that announces huge spending plans and the stock falls?
Yeah, Julia, the gap there is expectations. And so, like you referenced, at the midpoint of their CapEx guide, $180 billion, double last year. We had been forecasting $125 billion. Sell-side consensus was $115 billion. And I felt like just in our investor conversations leading into earnings, investors were around $130 billion. And so it's actually, it's a pretty big gap. And so I think investors today are digesting, one, this guide on CapEx, but also with it, and what you just led with, this cloud revenue acceleration was massive. So you are seeing the AI demand and investments in cloud search growth accelerated, and Sundar also mentioned that there are capacity constraints still, just given the strong demand at cloud, at search, et cetera, for the strong AI demand, and so they're going to double CapEx, and they also said, like, even despite doubling CapEx this year, they're still going to be constrained entering next year. So that just gives you an idea of just how much demand there is for their AI offerings.
So it sounds like you think that maybe the sell-off is a bit of an opportunity for investors to step in, or that it's sort of misguided?
For sure. I mean, yeah, it's looking down 4 to 5% today. And let's, to be fair, the shares are up 60% over the past year. Sure. So, for us, I mean, if you look at Alphabet, I mean, they have arguably now the leading foundation suite models with their Gemini suite of models, which is driving, kind of like I just referenced, the cloud growth and all the opportunities there. And then, like, if you look at search, right, their core business, search growth accelerated by a couple points, beat street estimates. It was broad-based across verticals, across geos, and they said that AI mode and AI overviews drove record engagement at search, which is pretty historic. And if you go back over the last year, I mean, Alphabet's done an incredible job, with its Gemini suite of models, B, incorporating AI tools like AI mode and AI overviews into the kind of broader search umbrella, and really kind of stave off that sentiment that was out there the last couple of years of ChatGPT being a big secular risk to Google search. And so, from that perspective, we're entering the year for Google. Their businesses, search and cloud, are in really good shape. They're accelerating. So, it may take a step back today, but I think the story is over the next couple of years, still a great story.
To your point about Gemini, I thought the numbers were interesting there. That 750 million monthly active users on the Gemini app, which of course doesn't capture desktop or people going to a browser, I suppose, and using it. And then they said they had, 8 million paid users on Gemini Enterprise, which was also interesting. How do you think about Gemini as the engine for some of those other things that you were talking about, and sort of how the consumer-facing users on the app or wherever then feed into the enterprise flywheel too?
Oh yeah, no, it's the Gemini 3, Sundar was talking about it last night, how great of a model it is, and you're right, like you're seeing it in the enterprise. Yeah, the 750 million on the consumer side, 750 million MAUs. That was up from 650 million at the third quarter. And they said engagement is also rising in the standalone Gemini app. They also called out the Apple relationship and how they're partnering there, and how this is from the enterprise perspective. Apple's going to be building their foundation models off of Gemini and off the Gemini suite of models. So it creates, when you have kind of leading tech like this, leading foundation models, it creates incredible optionality for Alphabet, both on the enterprise side and on the consumer side.
The other thing I wanted to ask you about was a comment that the CFO made on the call, that the AI agents are writing about 50% of Google's code at this point. I mean, do you anticipate a big wave of job cuts at some place like Google if that is indeed the case, that they're just not going to need as many people to do coding there?
I don't think so. And you had some headcount growth. We're past the days of right after COVID where these companies were adding a crazy amount of employees. And I think you saw at the Amazon, they're obviously cutting, but I think for Alphabet we have modest headcount growth. And one of the benefits of this technology is the productivity gains. But if you go back to the Meta earnings last week, I think their CFO said, this was in the callback. She said, "Yeah, we're seeing productivity gains with our engineers." And someone asked if they would cut heads, and they're like, "We actually may add more. More great technical workers that are more productive can kind of drive their business." And I don't, so I don't see Alphabet with broad headcount cuts to come, but headcount growth has slowed definitely, obviously, over the last couple of years.
Right, and we got Challenger Grain Christmas numbers this morning showing lots of job cut announcements in the month of January. I wanted to ask about Waymo and its role here too. Of course, it was in the other bets part of it, right? So again, when you think about these things that sort of seem like side businesses for Alphabet, of which it has many, how do you think about what it means to the business?
Yeah, I mean, Waymo, I think they're raising at $110 billion valuation. It's still a really small part of the overall Alphabet valuation. But I mean, they're the leading AV tech, full stop, in the United States. They're in 6 markets now. They just launched in Miami, I think, last week. We think they're going to be in upwards of 20 markets in the US and London and perhaps even Tokyo by the end of this year. They're definitely accelerating their roadmap. And it's been a long-term investment, and that's what Alphabet does. They bet on the long term. And so over the next 5 to 10 years, Waymo is going to be increased. We're going to increasingly see Waymo, in the U.S. and outside the U.S. Definitely a part of the rideshare industry. I also cover Uber and Lyft, and then we'll see how it evolves and if it becomes if they partner with OEMs and kind of the technology is on the autonomous technologies on vehicles that consumers can buy.
Finally, I do want to get your take, John, because obviously you're positive on Alphabet. We're seeing the shares under pressure today, but this is happening amidst the backdrop of a bigger tech sell-off, right? Yes, a lot of it's concentrated in software, but it has gone well beyond software at this point. What do you think that reflects? How far do you think it could potentially go? And what's going to regain the confidence of the market in some of these names?
Yeah, I mean, I always go back to, kind of execution. We're going to have to look at execution, and we're going to get Amazon tonight. I also think it should be good, and we're bullish. We're bullish on Amazon, but I think it would be the companies executing and proving out that there are returns for these AI investments, and work on the part of folks like myself and my peers and investors on figuring out the returns for this really historic AI infrastructure investment cycle that we're in. I don't know in the near term if the tech tape is gonna turn up, but I think you're seeing like the fundamentals for these companies are really in great shape. Obviously, we've talked about Alphabet. Meta's fundamentals are very good. And we think Amazon's are as well. We don't cover Microsoft and some of the other players, but yeah, so we'll have to see. But yeah, execute and follow their plans.
We shall see what ends up happening. We know they have big plans, that's for sure. John, thanks a lot. Appreciate it.
Thank you.
Welcome to Asking for a Trend. Breaking news. Apple earnings just now hitting the tape. And Yahoo Finance's Dan Howley is here with the numbers. Dan.
Yeah, Josh, big beat for Apple here on the top and bottom line. They said they recorded all-time record revenue for the iPhone, $85.3 billion. That's well ahead of the $78.3 billion that analysts were anticipating. The company saw $69.1 billion in the prior quarter. EPS came in at $2.84 on revenue of $143.8 billion. Analysts were anticipating $2.68 on $138.4 billion. So again, a big beat there. Services revenue was in line with expectations. And then we had Mac, iPad revenue at $8.4 billion and $8.6 billion respectively. Wearables came in at $11.4 billion. But one important aspect of this is greater China sales. Over the last 3 of 4 quarters, they had seen declines in that region. But now in this quarter, they had $25.5 billion in revenue. That's up nearly 38% year over year. So a big return to growth there out of China. This was something that Tim Cook had kind of telegraphed in the prior quarter earnings call, saying that they were expecting huge iPhone sales. Part of this has to do with kind of the lapping of people going out and purchasing tons of new smartphones during the COVID era. It's been 6 years now. People upgrade around that kind of time. The new iPhones, the 17, 17 Pro, they're interesting. They have slightly tweaked designs. I think it'll be interesting if we get any kind of color as to where the iPhone Air was in terms of sales. We have been hearing different inklings that perhaps sales volume of that particular model have been a little disappointing, and that a lot of people are flocking to the Pros and the standard iPhone 17. They don't really break those numbers down anymore, so we'll just have to wait and see. It also will be interesting to see what Tim Cook has to say about the recent tie-up with Google, where Apple and Google are going to be kind of combining with AI and having Google's Gemini power Apple's next-gen Siri.
Dan, let's just talk about this iPhone revenue number for a second, because this is still Apple's bread and butter, of course. This is blows past what the street was looking for. I mean, it clocks in around $85 billion. Analysts had penciled in closer to $78 billion. We knew going in here, Dan, that analysts had modeled that, listen, this iPhone 17 cycle has been strong. It's been solid. Why has it been solid, Dan? What's been driving that?
Yeah, I think it's that COVID kind of, timing, right? I mean, we'll probably see that throughout the next year, maybe 2, just because it's one of those things where people go out and buy, You don't buy a phone every 2 years now, right? You're not on a plan that lets you do that. So, you pay it off slowly over time, and then, maybe you just held on to it because you're like, well, I just paid off that part of the bill. Why do I want to tack something else on? And now you're probably thinking, all right, well, it's due. I'm several generations behind. I want to get the new hotness. I don't think anyone's going out to buy this because of Apple Intelligence. I don't think anyone's going to do that at any point unless this thing can, I could say, hey, Siri, get me tacos right now, and it personally delivers the tacos to my door. That's not happening. I think a lot of this has to do with the improved cameras, the improved screens. The battery life is a lot better. The slightly changed design, I think, piqued people's interest. If you look, you'll see a lot of people who have the new phones in that burnt orange color for the Pros. I think that got people pretty excited. And so that's where I think a lot of this came from, not necessarily, the fact that people are interested in iPhones again. It's just, I think that timing lines up. And, we saw that kind of with PCs this year, where PC sales in general were up 9% for 2025. It's that kind of lapping of the time frame where people go out and they say, okay, 5, 6, 7 years, that's where I need to go out and get a new device. TV sales might start to pick up soon too, because that's, another kind of device, but that's for another day.
Does it tell you anything too, Dan, just about how much time we spend talking about AI and consumer AI? But is this a window into how much does it really matter to a lot of consumers, whether it is a must-have feature or no? Right now, what consumers are focused on is listen, what they've always been focused on with iPhone, at least, which is it's the processor, it's the battery, it's the camera.
Yeah, I've probably said this enough to be annoying, but I don't think that people are going out right now and saying, boy, I really need to buy a new iPhone for that Apple Intelligence. And I don't think people are going out and saying that with their Google phones or their Samsung phones. A lot of people still use ChatGPT. Obviously, you can use that through the app. If you have a Samsung or Android phone, you can access Google's Gemini through their own individual app there. For Google's Pixel phones, it's built right in, right? So I don't think people are necessarily going out and saying, I need to buy a new phone because of AI. They're going out and saying, I need a new phone because my battery sucks. They're going out and saying, I need a new phone because I want a better camera or the screen looks better. That's how people buy these devices. The software is the software. When Siri came out, no one said, guys, let's talk to our phones like bozos, in public for no reason and ask it to play a song and then have it fail 8 times. They said, no, let's go get a new phone because the camera's good, the battery's good. And that's exactly what I think happened here. It's a great device. They updated the software with the liquid glass display. Whether or not people like that or not, that's up to them. But I think it's just a matter of the hardware being new and interesting again for the moment. Next year, we could have a foldable phone. That could even spark greater sales, although I'm kind of worried about the price tag on that.
Jay, it is good to see you. So listen, we have Apple's results. We don't have the guidance yet, Jay. As always, we'd expect executives on the call to offer some more color and commentary about what they see ahead. But give me your take on the quarter, Jay, and especially what you make of this iPhone revenue number, which easily beats the street. I mean, it came in, Jay, around 85 billion. The street was closer to around 78.
Yeah, so far so good. I mean, my basic thesis on Apple right now is very, very tactical in that the current cycle of phones, the current cycle of products looks really strong. People are buying those phones. Your previous guest was saying the same thing. People like the new phones, and sometimes it's as simple as that, right? I think the numbers look good, both in terms of top line for revenue, for iPhones, for China. China looked better than expected. And most importantly, for gross margins. The gross margins look really good this quarter, way above where I was expecting them.
I do want to talk about AI for a second here, though, Jay, because we know, listen, we heard Apple's going to use Google's Gemini models to power its AI efforts. That's going to include a more personalized Siri. I'm just curious what you make of that, Jay. What kind of impact you think that could have on the next iPhone upgrade cycle, in your opinion?
So I think ultimately AI is an existential threat for Apple. They need to get it right. But the good news is that they have time to do that. They don't need their own model today. They are in a good place working with Google, working with some of the other companies to sort of exist on the platform. Siri just isn't all that, right? It's not that exciting. It doesn't do that much, and it could use for people want better experience now. Though they're used to what ChatGPT or Claude has to offer, and having Google behind them should get Siri to someplace that's at least functional and useful, and give Apple time to sort out its own house and get its own AI team to where it needs to be.
Jay, you mentioned margins. Let's stay on that for a second because that was a big topic of debate heading into this print. A lot of your colleagues on the street were writing about this and specifically the rising memory costs, Jay, and they're wondering, okay, they're trying to game out and model what could that mean actually for Apple's pricing and margins in the quarters ahead. How do you see it, Jay? What levers does Tim Cook have to pull on that?
So it's a big question. It's why I'm really waiting to hear what they have for the guide. That's going to be critical. They did get asked about memory prices on their last earnings call a quarter ago, and they said that they had put in place long-term agreements with the memory vendors that sort of lock up pricing for some long period of time. Since then, spot prices for memory have just kept going up and up and up. And eventually contract prices will converge with spot prices. And so that's a sort of ongoing risk this year, looking at where they're going to see, are they going to keep to that story that they have these long-term price agreements in place? It's really important for Apple, especially on the margin front. They make a lot of memory from memory, right? When you buy an iPhone, you pay an extra $100 to get another whatever amount of RAM or flash. That has a lot of margin baked into it. It doesn't cost them $100 to do that. And so what are they going to do sort of with those price increases? Are they going to make the consumer eat them? Are they going to, fit it into their own gross margins? We don't know. The guy's going to tell us a lot. And I think that plays out later in the year when we get what is probably going to be a folding phone. That's going to be pretty expensive. How much elasticity is there for demand? Are consumers going to pay big numbers for that? That may save them in the end.
What about Greater China, Jay? That's another important data point I just want to run by you. Q1 Greater China revenue, $25.5 billion. That was a beat. Your colleagues on the street, the estimate consensus, Jay, was more like 21.8. What do you make of that number? How do you see business for Apple in China kind of evolving from here?
I think Apple is in this weird place where it has to walk this very fine line. Like they're very dependent on China, both the market and for their manufacturing base. They're probably too dependent for their own good. So they have to walk this fine line between, Tim Cook going to see the president every occasion and saying all the right things in China. So far, they've maintained that. I think the fact that they're doing well in China, as we see a lot of changes taking place in the Chinese smartphone market, prices are coming down for all their competitors there. Apple's doing really well. It's a good sign. Like consumers in China still like Apple. They still like the brand, and I think that will carry the weight for at least for the time being.
Jay, great to have you on the show today. Appreciate that analysis. Thank you.
Thank you.
As we saw there up on the screen, those Apple shares are flagging a little bit because of some concerns around margins. You took the opportunity to actually upgrade the stock because you were really wowed by those numbers, right, and by the forecast. I'm curious how worried you are about the margin issue. Obviously not worried enough to not upgrade the stock.
Yeah. So when we look at the March quarter as a starting point, despite supply constraints and despite potential inflation as it pertains to memory, Apple guided to 13 to 16% revenue growth and a very healthy gross margin of 48 to 49%. Now, the company does not provide an outlook beyond the next quarter. So I do think that there is potential that the higher memory prices could affect Apple and could affect the margins. But I would say working in its favor is that Tim Cook is excellent at managing supply chain, and with the very surprisingly strong demand for the iPhone 17 lineup, there could be an opportunity to take price. So I'm a lot less concerned about the margin outlook for the second half of this year for those reasons.
Okay, Tom, I actually want to play what Tim Cook had to say about the memory chip pricing issue on the call. Let's play that.
Memory had a minimal impact on the Q1, so the December quarter gross margin. We do expect it to be a bit more of an impact to the Q2 gross margin. We do continue to see market pricing for memory increasing significantly. As always, we'll look at a range of options to deal with that.
So I guess the question is, what does that range of options include, Tom? And for example, do you think that that Apple's going to raise iPhone prices this year?
Yeah. So again, I think that the surprise, at least to me, was how strong the iPhone lineup has performed, despite Apple really having a substandard AI solution. So I actually think that's very bullish coming out of the quarter. And because of the strength of the demand, I think it does have pricing power. The other potential advantage would be for memory prices to come down later this year. And then again, I think that the strength in managing the supply chain is why I'm less concerned than maybe the market is by the flattish performance of the stock, despite the blowout quarter and excellent outlook for the March quarter.
You and I have talked about the AI story or lack thereof with Apple before. And as we've talked about, our tech editor, Dan Halley, says he's not convinced that people are going to buy an iPhone because of the AI, just like they weren't buying it because of Siri, for example. I know you feel a little bit differently about that. Do you think that Apple is starting to make some more significant progress on that front?
So first off, I think that the strategic partnership with Google essentially de-risks AI for Apple as it relates to investors' concerns about it. Now, what's going to sound strange view here is that I think that being slow to have an AI product is actually working in Apple's favor, because I think you're seeing a lot of consumers recognize that there's, for example, a lot of hallucinations going on, and that some of the other companies that have AI products on the market today, those products aren't necessarily perfect, and in many cases are flawed. So I actually think that and again, I didn't think it would play out this way at all, but being slow to market with AI, actually I think it has worked in Apple's favor. But the good news is, and yes, I'm skeptical like Dan, that Siri is going to be materially better when enhanced with AI. But I do think that over time, I expect Apple to at least be at par with the market when it comes to consumer services related to AI.
Tom, kind of to your point about the delay, have we figured out what the killer app is in terms of AI usefulness on the phone?
So it seems like, so I also wonder, Julie, about the OpenAI ability to generate a profitable business from AI. So stepping back and just looking at AI at the industry level rather than Apple specific. So I think it's unclear. If you look at Meta platforms, they're clearly benefiting from using artificial intelligence to improve the relevancy of their advertising and improve their digital advertising effort. But that would be more of a commercial solution for AI than necessarily one as a consumer. There's a lot of usage as it relates to search, but I anecdotally feel that Gemini isn't necessarily materially better than what I see from the legacy search results from Google and things of that nature. So yeah, I think, again, it's unclear to me what the killer consumer app is as it pertains to AI, and I think that's benefiting Apple in being slow to market.
And obviously we've seen yet more headlines on OpenAI. Amazon, for example, reportedly considering an investment in the company. As you think about that sort of ecosystem, if you will, Tom, are there other interesting investing opportunities at that point, especially since we've seen a little bit of a wavering in the AI investment enthusiasm so far this year, seemingly among investors?
Well, what I like, Julie, is I feel like investors are being thoughtful in saying, where's the return on the investment spend? And I want to get more comfortable that there is going to be a return on the investment spend, because the level of investment spending is just enormous. And then I guess the good news or bad news of having covered the internet since '96 is it reminds me of your company, so Yahoo, the early days of the internet, when it had a disproportionate amount of advertising revenue from startups. And I worry that Amazon, companies that I don't cover like Oracle and Microsoft, are over dependent on OpenAI to the extent that this is still a startup, a very highly valued one. But again, they haven't figured out what their long-term business model is and if they could generate a profit. So I guess my concern for AI is that, we'll go with Amazon, that it may be over dependent on some of these startups when it comes to either cloud computing revenue or things of that nature. So that's the risk that I'm trying to monitor.
And I guess Apple is not as levered to some of those things, interestingly. Tom, thank you so much. It's great to see you.
You too. Thank you.
The iPhone revenue climbing 23% year over year to an all-time record of more than $85 billion. Let's talk more about it in the tech landscape more broadly. Joining me now, tech editor Dan Howley and Paul Makes, Freedom Capital Markets Managing Director. I just saw those shares are a little bit higher now, which is a turnaround. Dan, you were tracking those numbers as they were coming out. Now that you've had a little time to percolate, to simmer, for the numbers to simmer, what are your top takeaways, Dan?
Yeah, I mean, obviously, explosive iPhone revenue, right? Just out of control, blew away. The estimate said 85.3 billion was the number that came in for iPhone revenue itself. The expectation was for 78.3 billion. The prior first quarter last year, that was 69.1 billion. So just a huge year-over-year jump and easily outstripping estimates. Also beat on the top and bottom line. Revenue about for services just came in line at 30 billion. So, a big quarter for the iPhone. However, that also is playing into the future quarters for Apple because now they're actually constrained when it comes to chips that they put into the iPhone, those nodes that they put in, the packaging that they do for those high-end chips for the phones themselves. And so Tim Cook was saying on the phone call, basically, look, we're trying to do what we can, but we had seen such intense demand, more so than we expected, that it's going to impact supply going forward. And then, on top of that, remember that little memory thing we've been talking about, just a small global shortage. Well, that's now coming into play with Apple. And so for them, Cook was talking about how it's likely to impact margins going forward. Now, they said that margins would be about the same for Q2 as they were in Q1, and that's not necessarily a bad thing for them. However, he did point out that it could be a bigger problem going forward. And so that's where people are going to have to look because the supply of memory is incredibly constricted right now. It's basically just going to the highest bidder. And it's not going to change anytime soon because of this huge AI data center build out. And you can say, well, can't companies just stand up new factories? You know how long it takes to build a factory?
Right.
A little bit of time.
Yeah, most definitely. So Paul, there's nobody bigger than Apple, right? I mean, I guess NVIDIA on the data center side, but are you confident that Apple will be able to navigate some of this memory chip pricing pressure? Will they raise prices? Will they have other levers? What do you think?
They definitely, given their heft, have buyer's power. If you were to take a look at Harvard Business School professor Michael Porter's rubric. But I would tell you, these are some tactical challenges. But I think the bigger strategic challenges here are, one, Apple, despite pretty subdued overall revenue growth the last couple of years, and maybe a little bit higher EPS growth because you have consistent stock buybacks. This has not been a fast growth company, and yet, it's trading even after I boost my EPS today for the out year at 29 times earnings. And they've had a nice resurgence with iPhone sales each of the last 2 quarters, and they have really impressed me with that. But overall, expensive stock. And so I think the stock had run into the quarter. And, there's still going to be, on a strategic basis, a lot of concern about what are they going to do and how they're going to monetize AI. So they do have some tactical short-term issues like the rest of the semiconductor, particularly with memory shortage and memory pricing. But I think those 2 strategic issues that I just mentioned are a bigger gate on the stock.
And just quickly on that front, Dan, they have made a couple recent moves on that in terms of partnership with Google and also an acquisition. What's the sort of thinking there on how that's going to move the needle?
Yeah, it was a QAI was that acquisition. I believe the information said that it was around $2 billion. So, a relatively large acquisition for Apple here. It's the second largest after Beats. This isn't something, though, that's necessarily going to go into, their overall AI plan. It seems as though this is going to be something that perhaps allows you to use AI in some way with regards to wearables, perhaps with the AirPods or a smart glass thing that they're working on. And Cook had talked about the Google kind of tie up here. This isn't the first time that they've worked with Google. Usually they're on the money receiving side because they use Google search as the default for the phones when it comes to the actual spotlight search, things like that, Safari. That's been a huge benefit for Google, but now Apple is leaning on them for the AI models. And so he wouldn't go into too much detail at all. And some of the analysts were trying to wriggle something out of him, but they couldn't get him to crack. But it does seem as though, it's a good direction for them when it comes to the AI itself. And this could just be a stopgap measure, right? Until they're able to get their own in-house models together and then implement them in some kind of, software setup. But, at this point, I still very much believe that nobody is going to buy an iPhone because of Apple Intelligence. They're buying these new phones because of the cameras, the kind of redesign, the fact that we're circling COVID, 6 years on just about. People are getting new phones, and the batteries are great in them. So it's I think more to do with the actual phones themselves. I've said this before. Nobody went out originally and said, "Boy, I can't wait to get that Siri in my phone." They were like, "Oh, that phone has a better camera. Let me go get that."
Or they just needed a new phone because we all need these things now because they're integrated, inextricably in our lives for good and for ill. Speaking of AI, though, I do want to move on and I got to ask you, Paul, about these reports that Amazon is in talks to invest $50 billion in OpenAI. So, I mean, it feels almost like another day, another one of these investments. We haven't had as many this year. So what do you make of that?
I really hope it happens because I formerly cover the neo clouds and other AI infrastructure builders. And it is critical, whether it through be a big private round or even an IPO later in 26, that OpenAI raises equity, and a lot of it, because so much of this ecosystem, Julie, is dependent upon the spending intentions of OpenAI, 1.4 trillion in only 4 years. Well, they're going to need to raise a lot of equity. So I hope this happens. I think the recent equity raise, which was very successful by Anthropic, makes me feel better about it. But I hope this works because, man, a lot of folks are dependent on OpenAI raising equity.
So this is interesting, though, that you say you hope it happens for the sake of OpenAI and the neo clouds, not necessarily for Amazon. I mean, is this a good idea for Amazon to be doing?
I think so. It depends on the terms, right? That's always the details. But do they lock in Amazon Web Services capacity? Do they have another opportunity, even besides that, working with OpenAI to monetize their own AI intentions? I would think that it could be a good deal for both sides, but I think it's particularly important for OpenAI.
Dan Ives, coming to you. Apple, you like this quarter?
Look, it was a phenomenal quarter. I mean, if you think about what we saw specifically with iPhone in China, I mean, that was robust tailwind, services strong. Look, but I think the issue with the stock, I mean, investors, it's all about AI. Investors want to see what the strategy is, what the monetization. Obviously, it's Cook keeping it, sort of close to the vest. But I think that ultimately is really going to be the key to why, we're bullish. And I think what you see is this is almost a sleepy, sort of pretty massive upgrade cycle that's taken place.
Dan, are you in a Wedbush office? I've never seen you in the office before. It's a lot for me to take in, Dan.
Look, there's a lot going on, Taz. I had to, I wanted to kind of blow your mind. So I'm in the office today. And, again, it's Friday. Who knew?
Well, count my mind as blown. Melissa, over to you. Dan brings up a good point, talking AI and Apple. How much AI initiatives for Apple, AI, the broader environment, how much of that is priced into Apple stock, you think?
Yeah, it's a tricky one. First of all, happy Friday. Thanks for having me on. I mean, there's a couple of interesting things going on from the quarter. I mean, they beat Visible Alpha consensus on the top line pretty nicely and also at the gross margin. But what really stood out to us was China. China beat consensus by over 20%. So I think, when we think about AI and we think about the second half, the question's going to be is what is going to be the catalyst for those numbers? What's going to drive top line? What's going to drive further upside in the gross margin? Is China going to be sustainable, and are they going to pull something magical out of their hat in the second half around AI?
Is that magical thing, Inez, you think it's this Google Gemini? I mean, Big Tim, he didn't want to get into the financial ramifications of this type of Google, but I mean, it's hard to tell how excited he was. That's just Tim Cook, but he sure seemed excited, and he sure seemed to think this could be a big lift to Apple over time.
Yeah, and it may be the perfect partnership for them, at least for the time being, and them having such a massive quarter. This could give them the runway, so to speak, for a even broader AI strategy later on. So even though investors were so concerned about AI last year, this could be a stopgap measure, as Dan Howley had been mentioning earlier, and this could be the perfect fit for right now. I thought that what was interesting was the memory comment on the earnings call, because that seems to be sort of a bifurcation that we're seeing now in the market with respect to some of these memory names that have been skyrocketing, and the demand, the bottleneck when it comes to memory.
Melissa, what really impressed me with Apple, a lot of things, the iPhone revenue, but Tim Cook got on that earnings call and he said, you know what, we're going to drive higher margins in the first quarter, higher than the street expected, even with these memory price these higher memory prices, these memory chip complaints. Isn't that the ultimate buy signal on Apple?
I mean, ultimately, what was a surprise was the gross margin, especially coming into the outlook. I mean, they guided 48, 49% gross margin. Visible Alpha consensus was 47.5, and we're currently at 47.5 for the second half. So that's what the market has priced in. So as my other two guests alluded to around memory, this is the question. Is Tim Cook going to be able to manage the supply chain and memory prices in a way that enables them to maintain and sustain those 48, 49% gross margins, or is the 47.5% the real number?
And as I promised, I'm going to get you on precious metals in a second. Hold on just a moment. Dan, while we're cheering Apple here, Google's going to report soon, probably a good quarter for them. I'm going to talk up Gemini. On the other side, this move lower in software stocks, SAP, Salesforce, ServiceNow, this has been abysmal. I mean, do you try to pick a bottom here, or do you just stay with the winners like an Apple and a Google?
Look, software, it's a guilty till proven innocent. And I think ServiceNow and obviously Microsoft and others, I mean, this is just on the street right now. It's almost a do not enter zone. Now, I think a lot of that maybe is overdone, specifically for some of the cybersecurity names, for even Salesforce and others. Look, it comes down to monetization fees. And that's what the street wants to see here. And I think what you're seeing is really a bifurcation in tech. It's kind of the haves and the have-nots. And that's really what's playing out across tech earnings season.
My next guest says this is a burning the ships moment for the company, marking a profound shift away from electric vehicles. George Gianarikas, a Canaccord Genuity Managing Director, joining us now. George, I love that imagery. It was very Game of Thrones of you, that, he's kind of burning the ships, moving ahead into the brave new future. Musk himself has said for a long time, we're not a car company. That's not why you should own us. That's not what we are. Does this make the moment that it actually isn't a car company?
It was incredibly symbolic for them to end S and X production. I mean, these are the two vehicles that sort of anchored the initial ascent of the company. And they've talked about obviously getting into robots and focusing on autonomy. But the two things that really stood out to us were this stop of production, but also the $20 billion the company plans to spend this year on improving production lines for robots, for autonomous vehicles, for batteries. And not included in that number is the potential for them to build a semiconductor fab. So this is a pretty profound shift in strategy. They may generate negative free cash flow this year. And it is exactly that. It's a burn the ships moment. And they're still making electric vehicles, obviously, but they're super focused on an autonomous future, a robotics future driven by AI, and also with clean energy with batteries and solar power. So it's a profound shift, and people should be ready for a ride downward in profits this year in free cash flow, with the potential to come out on the other side with just a sort of a next generation company.
Well, that ride this year, is that why the stock has now turned lower, do you think?
I think so. I mean, look, it was a jarring number. Frankly, it was disclosed on the call. It wasn't in a press release, so we had to sort of listen very closely to what they said yesterday and pick up on that. And for people to sort of think about how to model this company, 2, 3, 4, 5 years from now, it takes a lot more, just guesswork. Just because you have to think about, okay, how many robots can they sell in 2029, 2030? How many vehicles will they actually sell? Because if you think about what happens to the overall car park or just overall vehicle sales, if autonomy does really proliferate, overall vehicle sales across the world should actually see pressure, right? Because if we don't need as many vehicles to move around, it will just become more efficient. We'll all be able to put our vehicles into this Tesla network, so to speak, and have them move, be used 4 to 5 times more than they have been traditionally. So this is a really profound shift, and not just for Tesla, but for the world if they're successful.
George, I've always said that Tesla is a faith-based stock, right? It's not about like what's really happening. It's what you believe the company is capable of doing. And a lot of the time, those faith-based investors, their faith is rewarded. You're an equity analyst. You gotta, as you said, you gotta model it. You can't just sort of believe. How do you close that gap? And do you think that people's faith is going to be rewarded?
So first of all, we do. I think it's going to be rewarded. And second, I consider myself a little bit of a meat and potatoes analyst. I, like you said, like to look at earnings and multiples for the companies that actually have them. And Tesla has had earnings, and we've always sort of anchored ourselves to an earnings number 2 or 3 years out. And we did our best, to try to understand exactly what the earnings power for the firm is. And granted, there is a high degree of risk here, just because we don't know exactly what the trajectories for autonomy and robotics will be. But we get to around $11 in earnings, non-GAAP earnings in 2028. And you have to assume that they grow vehicle sales, and they sell a lot of cyber cabs, and they continue to sell the Model 3 and Model Y, and then they build a robo-taxi business, and they start to build these and sell these robots. And that's what you need to get to that $11 number, which is in our model. And so if you put a pretty healthy multiple on that, you get to our price target. And so that's what people have to believe, that they will be successful in autonomy, that they will actually start selling these robots, that they will start to make them. And one really important point here is that the company is extremely vertically integrated, right? So they've always had this mantra of vertical integration, but they're taking that in our opinion, to the next level. I mean, they are mining and refining lithium, for example, and they will start potentially to manufacture their own semiconductors. And this is important specifically because, he sort of alluded to this on yesterday's call, Mr. Musk did, that he sees geopolitical risk being an increasing factor to put into their business planning. So he doesn't want to rely on Taiwan Semi, in our opinion, for example, to get his chip supply. So this is extreme vertical integration, really interesting growth from robotics and autonomy. But you have to your point, take a leap of faith.
Well, and so as you try to sort of close that gap between faith and reality, do you think the robo-taxi plans are achievable at this point on the timeline that he's laid out? And probably more importantly, or more audaciously, perhaps the Optimus goals?
So in terms of robo-taxi, he did lay out several cities this year that Tesla plans to embark on and offer their service. They've started in places like Austin and in the Bay Area. So to answer your question, yes, we do believe they'll steadily climb that ladder and proliferate the robotaxi in more markets. And what he said on yesterday's call is that they would be even more ambitious if it wasn't for state and local regulators sort of having to sort of pass muster and make sure that they can get into all these jurisdictions across the country. And on Optimus, yes, it does take a leap of faith to believe that the world will start to increasingly deploy humanoid robots in factories and maybe even at home. And Tesla, by the way, is not the only company that believes in that kind of future. There at CES this year, there were a number of US companies and even more Chinese companies that are betting on a future that's dominated by humanoid robotics. Remember, Elon Musk thinks that every person in the world will have 1 or maybe 2 humanoid robots before we're all said and done.
I really don't want a robot, George. I don't know. I don't know. I'm long humans. what can I say? George, thank you so much.
I love humans.
I hope everybody will still love humans in the end. I really appreciate it. Thank you, George. For Tesla, it's big CapEx.
Yeah, I mean, it went from 8 billion in 2024 to, they say, over 20 for 2025. I mean, that's like, peanuts compared to Meta and Microsoft. But yeah, that's still a lot of money because it's part of their transformation. And I think that's sort of my big takeaway, among a few, is Tesla no longer a car company, right? They're spending all this money because they're saying that they're, quote, a transportation services company, right? What does that mean? I mean, they got rid of the Model S now. That vehicle changed the game for EVs, and they're getting rid of the Model X, which was one of their most audacious cars with the falcon wing doors in the back, right? So why they're doing this? Because they want to focus on FSD and robots, okay? And then so looking at FSD, Tesla revealed finally that they have 1.1 million paying FSD subscribers. They're going all in on growth there because they want as many vehicles as possible to have FSD because maybe they might actually join a Tesla robotaxi network. Now, Musk said last night that he said there's around 500 robotaxis circling around Austin and the SF Bay Area. We can't actually independently verify that, but that's what he said. Removing that safety driver that's sort of with the Austin and the SF Bay robotaxi network, removing that safety driver is a big deal, and we'll see that ramp up potentially this year, along with the number of new operating regions that they noted last night. The question is, how fast will that come in? Investors want that to happen really fast. And speaking of really fast, Optimus, right? So Optimus, how will that scale? You got rid of the Model X and Model S production lines to build the Optimus lines at the Fremont factory. Tesla looking to reveal the Optimus Gen 3 robot this spring. This is the one that's the production robot, and looking to scale production to before the end of 2026, which I think caught people off guard in a good way. And then they want an eventual capacity of 1 million robots a year.
Tesla, I think, made some very interesting comments to your point about stopping production of the X model and the S model and moving more into humanoid robots. And I think that is going to, in fact, be the future. He's made it very clear that's where it's going. So I think there's an opportunity in Tesla for anyone who doesn't own it, like me, to take another look at it.
You don't have a Model S or Model X. I think you're a gas-powered car guy like me, and that's cool, man. But why we should care about what Elon said about S and X, and if you like Tesla, you got to care, because now he's going to take those factory lines and he's going to start pumping out humanoid robots. At some point, Elon's got to, we need to see these robots, and they need to start making money, and they need to start making money real soon.
Right. And I think, he's taking us down that road. He's made it very clear that that's where he wants to go. And he's even showed us, right, in certain, you could see it in expos, you could see it at conferences, whatever. He brings out the robots, they talk about it. I think it is the future. I think he's going to bring it there. Look, Elon Musk doesn't promise and not deliver. He promises and he delivers. And so it's a matter of time of, converting that manufacturing from cars to these robots. But I suspect that it's going to be very exciting, and I suspect that he's going to do it, and he's going to do it in a big way.
Ellen, let me lean into your balance sheet analysis skill set. We were just listening to you talk about free cash flow on Microsoft. When Elon Musk hops on an earnings call and drops this mini bomb on everyone saying, we want to build terafabs, essentially a big giant building that makes computer chips to fund his various ambitions on robotaxis and humanoids. Do you want to hear that from an investing standpoint? Because that is going to suck up free cash flow, and that could impact the stock's valuation.
So Tesla has never traded like a normal stock in terms of valuing it on free cash flow or earnings or any kind of traditional measure. So on the one hand, yes, as an investor, that bothers me because that's a very expensive proposition. On the other hand, as a stock investor, I don't know that that's actually going to end up mattering to Tesla's valuation and how the stock trades. It's like a number of other companies where the free cash flow has never really mattered to investors, at least based on the stock price. But that said, fabs are really expensive, and we don't have the infrastructure to build them here in the United States in the same way that Tesla is talking about. So, for example, I was looking at the Lam Research Quarter last night. They're a semi-cap equipment company, and they're global, right? They sell to Korea, they sell to Taiwan, they sell to the U.S. They're dominant in their etch and deposition subsector. They had 5% of revenues from the U.S., okay? 20, 30% from China, Korea, Taiwan. And so unless we see the infrastructure being built out in the US to support fab growth, right? It's not just the fabs, it's all the components, all the suppliers, all the labor. It's going to be really hard for Tesla to build a mega fab in a way that's going to be profitable, that's going to have the yields that they need, that is going to generate the long-term free cash flow. So he can build it. Maybe investors won't care about the free cash flow because historically they haven't. But I think there's also a bigger question about whether or not that can really be successful, given what we see about semiconductor capacity buildouts in the U.S. right now.
Inez, real quick, do you view Tesla as a car company?
No, I mean, it's now autonomous. It is about robo-taxis, and it is about it's about their Optimus. I mean, he's made it super clear about that and how it will change. I mean, the future is autonomous. And if I were an Uber driver right now, I'd be shaking in my boots because they see the vast majority of miles being autonomous.
But right now, we got to pivot back to Microsoft because those shares, as I pointed out, are falling sharply by more than 11% as the company's CapEx spending plans spook investors, despite the fact that they topped second quarter earnings estimates. Joining me now is Rishi Jaluria, RBC Capital Markets Managing Director of Software. Rishi, it's good to see you. And hopefully you can sort of walk us through what's going on here, because I find it really interesting that sometimes investors hate more spending and sometimes they don't. Meta is an example of where they don't hate it today. Microsoft is an example of where it is seemingly more alarming. Is it just because like Azure is missed maybe some estimates? What's going on here?
Yeah, and thanks so much. Always a pleasure to be on your show. Look, I would say there's a couple things going on, and it's interesting you bring up the Meta comparison because 90 days ago everyone hated Meta's capex plans, but obviously they had a strong quarter, and you see that being reflected in their stock action today. With Microsoft, candidly, it feels like a missing the forest for the trees type of moment. Absolutely, people are picking on the CapEx numbers. The CapEx numbers were actually pretty in line with my expectations, but definitely above where I think the rest of the street was. And Microsoft has been telling us for a while now that they are capacity constrained, that they want to bring all this third-party capacity. Think about these deals they have with Oracle, CoreWeave, Nebius. They want to bring all of that back in-house. That means that's a lot more they need to spend to build out that capacity. And they're telling us that effectively the Azure numbers would have been meaningfully higher if not for the capacity constraints that they're facing. And so, it's almost like Microsoft's kind of stuck from an investor sentiment standpoint in the middle where, look, the Azure number I thought was strong, right? I mean, you could say, it wasn't 39%, it was 38% constant currency. But the fact is they added somewhere in the neighborhood of $9 billion of constant currency Azure ARR sequentially. And it was a broad-based beat. It wasn't just OpenAI, or it wasn't just AI, it was everywhere in the portfolio. And there's a lot more to talk about the print, but maybe it wasn't necessarily high enough for people that wanted a higher number, and the CapEx numbers are going up. You don't spend money on CapEx and build out data centers and immediately have that translate to revenue. These things take time to translate. I think it's creating a buying opportunity in this increasingly fickle and impatient market.
Well, let's dig into this timeline a little bit more, Rishi, because you wrote about this in your note as well. This problem of these capacity constraints. So if capacity is the problem, how long? I mean, it takes a long time to build out capacity, especially if they're building some of these data centers from the ground up as opposed to acquiring or what have you. Like, what does the strategy look like there for Microsoft, and how long until they can expand that capacity?
Yeah, look, I think they can start to expand capacity slowly right away. And we start to see more 1P capacity come online. I think Microsoft has a multifaceted strategy to be able to meet demand. There is the building of new data centers, owning those, and those have ROI for a very, very, very long period of time, which is great because with Microsoft, you want fungible architecture that can be repurposed from training to inferencing, reasoning, post-training, et cetera. They're also doing third-party leases. They're also doing third-party data centers. So anything that they can to bring more capacity online, they are doing that. Now, the question becomes, well, when can they hit a point of parity in which they are no longer capacity constrained? Look, it's not going to happen until at least the end of their fiscal year, which is June fiscal year end. It could be after that. It just depends on the rate of AI demand. And look, I mean, clearly we're dealing with unprecedented AI demand given the arms race going on between the model providers. But you're also seeing this uptick in enterprise AI demand. And I think that's what got lost in the noise around Microsoft's print is a lot of the data points it gave us, be it Fabric, GitHub Copilot, M365 Copilot, we're strongly encouraging that we're starting to see the AI tailwinds not just be about brute force training of models and capacity build outs, but there's actual enterprise adoption. And I think that's what's needed for this kind of AI trend, today's stock market action notwithstanding, to really continue, and for that all-important moment that everyone's waiting for when we start to see that kind of rotation from semis into software.
Rishi, I did think that was, some of the data points that you brought up I thought were really interesting. That 15 million subscriptions for M365 Copilot, the contribution from OpenAI to net income of $7.6 billion was also interesting. I'm curious, as they give us sort of this transparency, if there's anything else that you want from Microsoft in terms of data. Are there other questions that you have about as they sort of shift the business model that would help you kind of analyze the company?
Yeah, look, I think what could really help us is, it's good to get some of these paid user numbers. And one metric, by the way, that really stood out to me in addition to the M365 Copilot number was Microsoft Fabric reaching $2 billion of ARR, up 60%. Bear in mind, they launched that product less than 2 years ago. So I think that's a very, very impressive trajectory we're seeing there and showing the kind of strength and breadth of Microsoft's portfolio. What I really want to see, though, are some really strong user engagement, user value metrics, because there's always going to be new fears that pop up. Now it's people asking about Anthropic Claude Cowork, but really I think if we can start to see data points of users are spending more time and engaging more with the Office suite because of M365 Copilot and all these AI-enabled features, that more developers are spending more time putting more code in GitHub because of GitHub Copilot. If we start to see that, I think that's a great leading indicator for future monetization, because really, the way we think about AI monetization in software is it is innovation, utilization, monetization. And so I would love to see more of those forward-looking indicators, but I do appreciate the greater transparency that Microsoft is giving us now.
Rishi, on the point about OpenAI, they gave that net income contribution number. It seems like even without that, they would have beat estimates. That said, it seems like there is some concern out there about how leveraged they are to OpenAI, the relationship with OpenAI. Is it a liability or is it a benefit?
I think it's actually a strength. Look, I think the more important number that's coming out is that OpenAI represents 45% of commercial RPO. That's basically a measure of think about as forward-looking backlog. Now, I think that's a conservative number because they are kind of risk adjusting it, especially on a duration impact. But I think two things are really important here. Number one, OpenAI is still, for all the kind of gains that Anthropic and Google with Gemini have made in 2025, OpenAI is still also at the cutting edge of this, right? I think it's candidly a three-horse race, and it's an oligopoly between these three model providers. And Microsoft still has research rights till 2028. They have IP rights until 2032, which includes AGI, and that means, by the way, no gross margin drag. They have API access. So I actually think that OpenAI relationship is a huge strength for them. But the second thing that I would say that I think gets missed a lot is when we think about all these applications that they built, be it M365 Copilot, GitHub Copilot, Dynamics, security, et cetera, they're all built in a modular fashion. That means they're model agnostic or actually multi-model in nature. So you can choose to use OpenAI or Anthropic or even open source, be it Mistral or Llama, under the hood of these. And so the future fortunes of them at the application layer and the developer layer, the security layer, are not dependent on OpenAI. It's dependent on AI as technology and these models evolving. And I think that gets missed as Microsoft has built these products in such a way to hedge their bets that, even though obviously OpenAI doing well would be a good outcome for Microsoft, the future of Microsoft is not entirely dependent on OpenAI.
Rishi, I wanted to broaden it out a little bit, and I want to play for you something that Kim Forrest of Bokeh Partners told Josh Lipton, who you know well. He asked her how software businesses navigate this LLM future, because as you know, many of them have been underperforming, and I want to play for you what she said.
Well, I think people really are leery of things like Salesforce that have been growing because they've been adding functionality. And now people think, well, you could just, use Claude and write whatever you want. Well, as an ex-software engineer, good luck with that. I think it can help people write code, but I'm always kind of skeptical about that.
And so I wanted to get your take on that, Rishi. This sort of cavalier assumption that, oh, we don't need these enterprise software companies anymore because people are just going to vibe code everything.
Yeah, no, and I fully agree with what she's saying. Look, I would say this is, yes, barriers to entry in software have come down. You and I could probably create a software product that's a minimum viable product, get it out of the market with $500 in 6 months of time. And I'm not a software engineer by trade myself. But I think this is a great thing. It means the software TAM is going to grow. It means more innovation, and more innovation means more customer success. And that means a larger TAM that we can go after. And so I agree, like enterprises are not going to be vibe coding. Where I think it creates a little bit of pressure on a company like Salesforce is the ability to upsell new products, because customers are going to say, hey, we see that barriers to entry are coming down. We're going to push back on price increases. It'll be harder to expand. So I think there's some there at the margin, but that's also missing the opportunity that so many of these companies have to actually double down on innovation, double down on customer success. I would point to a company like HubSpot, for example, or even Microsoft that we're talking about, where they can actually double down on AI, actually innovate around it, and not just bolt on an agent or two, but really go AI first and AI native. And there's ways to really monetize that in a meaningful way over time, to the tune that I think we can look at 2x to 3x customer lifetime value from true AI native products that can do things that we couldn't under the traditional SaaS paradigm. And I think the market is outright missing that in so many of these software companies out here. And I think, especially with today's pullback, it's created so many great buying opportunities that I truly believe we're going to look back at 3 years from now and say, I wish I stepped in.
Okay.
And that's the time for us to step in.
What's going to make the market realize that? I mean, I'm looking at a HubSpot, for example, that's down 29% over the past year. What changes to, for the light bulb to go off?
I think two things need to happen. Number one is we need to see acceleration in growth, right? Accelerating growth just cures all manners of sin, no matter what the bear narratives are. And we've seen this play out last year with MongoDB, Snowflake, Datadog, et cetera. And so HubSpot, for example, is a name that I think can actually see acceleration without the benefit of AI. I think the AI story starts to show up in monetization in 2027, but even this year, I think they can accelerate. Same with Intuit, same with Microsoft. And I think it's accelerating growth is piece number one. But I think piece number two is actually showing proof points around AI. If HubSpot or Intuit or even Microsoft has started to show us metrics around this as well. If they can show metrics that customers are coming to them, they're using their AI solutions, they're getting real value out of it, it's driving greater engagement, and they're not instead escaping to adjacent solutions on the model providers, I think that starts to really poke holes in that bear case, on this existential AI and software bear case. And I think that really starts to kind of show how dislocated some of these stocks are. So those are the two things that we'll be watching for during this earnings season and beyond.
Rishi, I feel like if there was a table in front of you, you'd be pounding it. You're fired up about this stuff. I love it. Thanks so much. Appreciate it.
Thank you so much.
Take care.
Out of all these quarters that just reported, which one did you love and why?
Well, listen, I don't own Tesla and I don't own Meta. So I looked right at Microsoft because it's one that I own. It's one that I like. I wasn't fazed at all by the negative reaction that we saw in Microsoft. You made a couple of very key points. I'm in it for the long run. I think the reaction is an overreaction. I think it provides an opportunity to buy a quality name at a discount. Now look, Meta shot straight higher after Zuckerberg got done, and that's great. And look, they got an $800 price target on it. I think it's traded $7.25 right now. And Tesla, I think, made some very interesting comments to your point about stopping production of the X model and the S model and moving more into humanoid robots. And I think that is going to, in fact, be the future. He's made it very clear that's where it's going. So I think there's an opportunity in Tesla for anyone who doesn't own it, like me, to take another look at it and to jump on. But I was while Microsoft was a negative reaction, I look at it as an opportunity to pick up a quality name at a discount.
Kenny, as if I needed a reminder why you're my favorite, I am reminded today because you always shower me with praise, love, appreciate it. Ellen, I'm going to stay on Microsoft. Kenny's fired up on Microsoft. Did this quarter excite you? The street not liking what they had to say on CapEx, the cloud sales, maybe not so good. I mean, they did grow strongly year over year, but there were some negative points in this quarter from MSFT.
So as I look at Microsoft, I think the key thing that was problematic not only the Azure revenue year-over-year growth missing by a little bit, not too bad, but the free cash flow just plummeted, right? It was down to $5 billion. It's usually in the 20 billion range. So what we're seeing is Microsoft is spending all this CapEx. Okay, fine. But you need to be able to have cash flow from operations to fund that. And they didn't have that. And then you look at the CapEx that they're projecting for this year, and it's going to be problematic as well. So I think the question is, and why the market likes Meta so much more right now, is are you going to be able to see the return on that investment? And with Microsoft, they're talking about, yeah, we have 15 million Copilot paying subscribers, which is kind of a small number when you think about the scale of Microsoft corporate business altogether. But are they going to be able to get the return on that? Meta put up the numbers, and we'll see what happens. The thing that concerns me is that they're talking about 115 to 135 billion in CapEx this year, Meta. Last year, they had 115 billion in cash flow from operations. So they better start producing increased cash flow if the market is not going to penalize them next quarter when the CapEx shows up in their free cash flow numbers.
Ellen, as a former analyst, I love that you're coming up here on our roundtable talking about FCF, that's free cash flow. Inez, coming over to you. Look, these Microsoft earnings calls have gotten really boring. I barely even know what they're doing anymore, full disclosure. It's become such a complicated company. But I'm listening to this call, and then Satya drops this nugget that 45% of Microsoft backlog is tied to OpenAI. And if you're concerned about circular financing as it pertains to AI, that is a number you don't want to see.
Exactly. The circular financing is something that the street has really been concerned with. And you've seen it with some of the sort of stock performance from some of these companies, especially also when it comes to software companies. These have not performed so well. But, going back to these reports, look, I think that I agree that with Meta, they have been able to show several points that agents are working. Their shopping tools are getting better, and this is very significant for their bottom line. And also talking about even productivity within the company. I found it so interesting that they said that since the beginning of 2025, per engineer, they have seen an increase of 30% output, that their projects that used to take now a lot more people are taking less people. I think that these are some of the signs of why you're seeing sort of the divergence in the stock performances between, for example, a Microsoft and a Meta that was able to highlight some of these points.
All right, let's keep this cooking here. That was good Microsoft analysis. Kenny, I'm going to go out on a limb and say that you don't have a Model S or Model X. I think you're a gas-powered car guy like me, and that's cool, man. But why we should care about what Elon said about S and X, and if you like Tesla, you got to care, because now he's going to take those factory lines and he's going to start pumping out humanoid robots. At some point, Elon's got to, we need to see these robots, and they need to start making money, and they need to start making money real soon.
Right. And I think, he's taking us down that road. He's made it very clear that that's where he wants to go. And he's even showed us, right, in certain, you could see it in expos, you could see it at conferences, whatever. He brings out the robots, they talk about it. I think it is the future. I think he's going to bring it there. Look, Elon Musk doesn't promise and not deliver. He promises and he delivers. And so it's a matter of time of, converting that manufacturing from cars to these robots. But I suspect that it's going to be very exciting, and I suspect that he's going to do it, and he's going to do it in a big way.
Ellen, let me lean into your balance sheet analysis skill set. We were just listening to you talk about free cash flow on Microsoft. When Elon Musk hops on an earnings call and drops this mini bomb on everyone saying we want to build terafabs, essentially a big giant building that makes computer chips to fund his various ambitions on robotaxis and humanoids, do you want to hear that from an investing standpoint? Because that is going to suck up free cash flow, and that could impact the stock's valuation.
So Tesla has never traded like a normal stock in terms of valuing it on free cash flow or earnings or any kind of traditional measure. So on the one hand, yes, as an investor, that bothers me because that's a very expensive proposition. On the other hand, as a stock investor, I don't know that that's actually going to end up mattering to Tesla's valuation and how the stock trades. It's like a number of other companies where the free cash flow has never really mattered to investors, at least based on the stock price. But that said, fabs are really expensive, and we don't have the infrastructure to build them here in the United States in the same way that Tesla is talking about. So, for example, I was looking at the Lam Research Quarter last night. They're a semi-cap equipment company, and they're global, right? They sell to Korea, they sell to Taiwan, they sell to the U.S. They're dominant in their etch and deposition subsector. They had 5% of revenues from the U.S., okay? 20, 30% from China Korea, Taiwan. And so unless we see the infrastructure being built out in the US to support fab growth, right? It's not just the fabs, it's all the components, all the suppliers, all the labor. It's going to be really hard for Tesla to build a mega fab in a way that's going to be profitable, that's going to have the yields that they need, that is going to generate the long-term free cash flow. So he can build it. Maybe investors won't care about the free cash flow because historically they haven't. But I think there's also a bigger question about whether or not that can really be successful, given what we see about semiconductor capacity build-outs in the US right now.
Inez, real quick, do you view Tesla as a car company?
No, I mean, it's now autonomous. It is about robo-taxis, and it is about it's about their Optimus. I mean, he's made it super clear about that and how it will change. I mean, the future is autonomous. And if I were an Uber driver right now, I'd be shaking in my boots because they see the vast majority of miles being autonomous.
Well, we're glad you're not an Uber driver, Inez, because we need you on this roundtable. And before I go, big moment for Yahoo Finance. We have launched our Polymarkets hub right on Yahoo Finance. It's an amazing site. I was scrolling through this, guys, this morning, and one prediction area caught my attention is who do people think will be the largest tech company by the end of June? Let's toss that up on the screen. It was pretty fascinating. Kenny, it's a battle between the likes of NVIDIA, Google, and some other big cap tech names. Who do you think is best situated to be the largest tech company? Is it still NVIDIA moving forward?
NVIDIA's right up there. If it's those four names, I am going to go with NVIDIA. If it's Microsoft, Apple, and Alphabet, if that's what we're looking at, I'm going to go with NVIDIA.
Ellen, another one I was just briefly scanning this morning was who will have the best model by the end of January. I mean, of course, it's almost done because January is almost done. But Google, 100% of people think that Google will have the best model in the market. And I hear what Kenny's saying, but Google's making a strong case to at least, if they don't make it to June, end this year as the world's biggest company.
I think Alphabet has a really good shot at getting that because they have a much less capital intensive model than NVIDIA, even though they still are spending a lot of capital, but they are able to grow advertising. They're able to catch up with OpenAI when people thought they were left for dead a year ago. So I would go with Google on this one.
And as I assume you're coming in here with NVIDIA.
Hands down, Alphabet,
wow.
definitely.
Wow, okay.
Yeah.
Okay. All right.
They've got YouTube, they've got the ads, they've got Gemini, they have all of those, as was just mentioned.
Nez, you're always full of surprises. I appreciate you all. Amazing analysis on a big morning for earnings. You are all the best.
You see opportunity, Alex, because you know these names so well, and so I'm just very curious to get your take on the report. Microsoft, for example, which is getting nailed today, Alex. The spending continues. Capital expenditures for Q2, nearly $38 billion. That exceeded what the street penciled in. Meanwhile, Azure jumped 38% when adjusted for currency. That just met analyst predictions. Copilot, so it's AI assistant, 15 million users. Maybe some folks were hopeful they would see more there. And I wonder, do you think what's going on is just big picture with Microsoft, Alex? Folks are wondering, where is the payoff, Satya Nadella, for all this spend?
So it's really interesting. I think Microsoft is a very large and complicated business, but investors like to boil things down into something simple, which is there a part of the business that's really exciting, that's accelerating growth, that can drive the rest of the business to accelerate as well? And for a long time, that has been Azure. And Azure has been growing, and it's the fifth straight quarter of kind of high 30s growth. And a year ago, if someone would have told people that that's the growth rate, they would have been really, really surprised. I think right now, investors were very surprised that instead of accelerating growth, Microsoft made the kind of unique decision to allocate scarce resources to their own products and their own research efforts at the cost of acceleration. And so it's just a really unique phenomenon that folks haven't really seen before to this degree and magnitude. I think it's the right decision for the business. I think Microsoft feels like, look, we've got 15 million Copilot seats. We've got 450 million Office user seats. If that's a 3% penetration for a technology that we think is going to be the cornerstone to the future of how people work, because today it's a Copilot, tomorrow it's a coworker, as some wonderful LM companies are demonstrating for them. And we can't lose, we have to win that battle. We have to win that ground. And that is a higher margin business for us overall longer term. So their view is if we can divert, we're in a GPU constrained environment in terms of how much capacity we can bring up. If we can kind of divert more resources there, we can get a much better holistic kind of AI driven business over the long term, as well as on the research side where we think they will and are working on some of their own proprietary frontier models that will ultimately increase their competitive positioning vis-a-vis companies like Google.
Alex, you mentioned ServiceNow, and I do want your take on that one too, because you look at that sales outlook in the current quarter, it was stronger than predicted, Alex, but again, clearly just plenty of investor skepticism about the AI strategy here. I know you tell your clients, listen, this one's a buy, how come?
Look, we think at some point, companies will start to see more agents being adopted inside of the four walls, accessing privileged information, interacting with all manner of critical systems. And at that point, there's going to need to be a platform that, IT and technology leaders trust, depend on to manage, control, and shape how those agents are working. Today, we have IT departments for people that use technology. Tomorrow, we're going to have IT departments that manage the agentic spread and kind of swarm happening in companies. And we think ServiceNow is extremely well positioned to do that. They have done a few large deals over the course of the last few months that I think spooked some people. We think that they have kind of taken the necessary pills to expand into other markets and other adjacent opportunities, as well as amplify some of the innovation that they were driving internally that's going to unlock accelerating growth. And quite frankly, investors are saying if you're not accelerating at a time when you're telling us the markets are expanding, you're spending so much money, industry writ large, on capital expenditures to grow this pie. If you're not accelerating now, something's wrong. And we think ServiceNow is going to accelerate. I think the other element that people want to see is really margins and margin leverage. If we're adopting all of this fancy AI technology internally to drive more efficiency and productivity, where's the proof in the numbers? And so accelerating growth, improving margins, and sometimes even inflecting margins, I think is what investors need to see. We think ServiceNow is going to deliver that over the next 12 months, and we're using today's opportunity as a buying opportunity.
Another buy you got, Alex, and I'll end here, Salesforce. Now this one, we're down about 40% over the past 12 months. What does Mark Benioff, Alex, what does he need to say and do to convince investors, you know what, his stock is a smart opportunity?
Accelerating growth and improving profitability. I think that similar to ServiceNow, the last 12 months have seen Salesforce embark on some large-scale M&A that they've done, at a time that was considered to be a little bit surprising for the markets. I think they've undergone a full strategic pivot around Agentforce, this agentic AI platform that they believe is the future of apps, and we would agree. So we think concrete examples where customers have adopted, not just adopted, but are actively using and paying for this technology, and it is additive, accretive to the growth rate. If they can lay that out, that this is, again, we've turned the corner on the growth, and we are back on a pathway that leads to something that's closer to double digits over the course of the next year or two, and not just in words, but in concrete proof in the bookings growth rates of this business. I think that's what investors are going to want to see, because there's a lot of companies that are private directly in the space that are putting up some serious points on the board that, quite honestly, are frightening from a competitive perspective to institutional investors.
Alex, good to see you as always. Thank you.
This time, its spending plans once again blowing away expectations, but the stock is higher.
Yeah, I mean, spending is through the roof. It's bonkers how much this company is going to spend. 100 billion plus in 2026, fiscal 2026, and so they basically said in the prior quarter we're going to see meaningful growth when it comes to spending, and they certainly delivered on that. They spent 72 billion in the last year, and so that's a pretty huge jump, nearly doubling what they had spent in 2025. And yet, yeah, the street reacted positively to this. It seemed to be, Meta's been a laggard. Microsoft's been a laggard too. The only one that hasn't been a laggard has been Google, thanks to Gemini 3. But I think part of the message here with Meta was kind of this AI reset that they've been undergoing. They fell short with their Llama 4 behemoth, just delayed, I guess, forever now. We haven't heard much about that yet. It was supposed to come out in April. No sign of that. And on the call, Zuckerberg was kind of going over how, he's legitimately said, we're in like an AI reset. And so, they hired all of these people. They continued to spend on all of these big names. And, I think that kind of gave a little bit more hope to the street. They talk about how they're going to be integrating large language models, their generative AI, into the algorithms that kind of keep you hooked. So I guess good luck trying to not stay on Instagram for, 2 hours at a time. And they're integrating it in ads, something that they've been doing. But it does seem as though the reaction just kind of flipped from the prior quarter, despite the just coming out with the numbers saying that they're spending as much.
Meta, just now, releasing its Q4 results. Joining me for the hour as we cover all of this, we've got Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. Let's get right to these results. So Meta Q4 EPS, I see $8.88. I don't see a clean compare yet on the bottom line, but Q4 top line revenue, $59.89 billion. Consensus was $58.42 billion. I'm looking for ad revenue. There it is. Q4 ad revenue, 58.14. The street was at 56.79. Turning to the forecast, the Q1 revenue, Meta is giving us a range here of between 53.5 billion to 56.5 billion. The street was at 51.27 billion. That CapEx number, there it is. We're looking for 2026 CapEx. Meta is giving us a range of between 115 to 135 billion. The street was closer to 110.6 billion. Just looking at the immediate reaction here, we're down nearly 3%. Now remember, heading into this sprint, this stock was basically flat over the past 12 months. It was actually down about 10% since they reported earnings in October. Now bulls will say, and by the way, there's plenty of them, more than 90% of analysts have a buy on this when they'll talk about industry-leading revenue growth. They'll talk about scale advantages, engagement. They will certainly talk about the attractive risk reward, but investors have had these questions about the company's big capital outlays, all the spending here on AI data centers, hiring the pricey AI talent, more questions about where the return is on all that. The initial reaction, we're lower here. I have just the man to talk to about this because Adam, you own Meta.
I do.
Walk me through why you own it. What do you make of the print?
Well, you have to own Meta.
You have to own it.
Yeah, you have to.
Why?
Well, you have to own all the core ingenuity companies. Meta, the obvious ones that we always talk about. Meta, Amazon, Google, Tesla. I would add Salesforce.com, ServiceNow, Palo Alto Networks. These are just core, big, best-in-breed companies that you have to own.
How do you define best-in-breed? When you're screening best-in-breed, why does Meta show up?
Well, do you know another social media company that has the reach of Meta? Nobody else reaches 2.2 billion people every day, except arguably Google, but that's different. That's search. And they dominate search. That would be best in breed. Salesforce.com is best in breed, literally number one for customer relationship management. We could go on and on. Palo Alto Networks for cybersecurity. That's best in breed. Meta is best in breed. What excites me about Meta is that they're monetizing every single aspect of it. And remember, Meta now, WhatsApp, has become the prime B2C, business to customer way of communicating, right? It used to be you'd call a 1-800 number or you'd send an email. Well, now actually all those bots, hi, my name is Susan, how can I help you today? That's all powered through WhatsApp, and they're monetizing it because they're getting paid for it. They're getting paid for absolutely everything they do. They're now selling ads in Reels. So that's a whole new thing that just started last week. So I think you have to own Meta.
But let me ask you this: how does Zuckerberg? How does he excite more people like you're excited? Because this stock, as I mentioned, we were down 10% since last time reported.
Yeah.
We're now battling back here.
Yeah, of course
actually
we are.
edging higher. But they see things like this. Look at this head. 2026 total expenses, 162 to 169 billion. Street was close to 151. And folks are just wondering,
they can afford it.
where's all the return on this?
Oh, they can afford it. I mean, this is not an issue. There are very few companies that are able to grow 20 to 30% per year at scale. Meta is one of them. Google's another. Amazon's another. In fact, even higher growth than that. Nvidia is another. That's why these companies trade at the prices they do, both the stock prices and then the valuation. So I'm very comfortable paying 25 to 35 times earnings for a company that's growing 35 to 40% per year. I mean, for perspective, the S&P 500 trades at 22 times earnings, but is only growing at 13% per year, right? So I'd rather pay up to get growth that in some cases is double or triple what the S&P 500 is giving me. And that's why I say you have to own these. And you can't worry about quarterly numbers. I mean, think how absurd that we come here every 12 weeks and say, okay, how are the last 12 weeks? And what are they going to tell us about the next 12 weeks? Imagine if you treated your children like that. You said, all right, kids, I got the report card. So the past 12 weeks are a little rough. How are you going to improve, over the next 12? I mean, really? They'd tell you, Dad, get lost.
Scott, it is always great to see you and to have you on the show. Meta just reported. Get me your take on the print, Scott. We were lower, then we bounced higher. What do you make of it?
Well, expectations for expenses had been rising throughout the quarter, and so I think that set the bar pretty low. Meta's spending a lot of money on CapEx and operating expenses in 26, but there's no real growth story in consumer, that comes near what Meta's doing right now. I mean, the business exceeded expectations in terms of revenue growth by 300 basis points, and then they guided at a midpoint to 30% revenue growth for the first quarter of 2026. So this story from a growth standpoint is very much intact, and I think that flips the narrative to the spending being very much justified.
And all the spending, Scott, when your clients ask you, okay, where's the ROI on all this spend, you tell them what?
The ROI is initially showing up in the revenue growth. When you look at operating profit dollar growth, they will grow operating profit dollars in 26, but Meta's building for the next 10 to 15 years and then reporting revenue on a quarterly basis. So it's one of the very few companies where AI monetization is showing up in real time, in results. And so you have short dated improvements in revenue growth, which should continue, and very long dated spend, which again, I think is on a time horizon of 10 plus years. And so as you get to 27 and 28, I think you'll see leverage again in the business model. And keep in mind, Meta trades at 18 times forward earnings now on a GAAP base. It's a very cheap stock for the growth you're getting.
So Adam, bring you in here as a Meta investor, shareholder, believer.
Meta shareholder.
You agree with what you're hearing from Scott here?
Oh, I completely agree with what Scott's saying. And herein lies the opportunity for investors. There's an arbitrage, naturally, for long-term, thoughtful long-term investors like Scott and I, who are taking a long-term view of the company. The company's taking a long-term view of itself. That's why it's making all these investments. And so we come in every 12 weeks and try to make these, we try to game the earnings. We don't. But the market does, trying to game earnings. Did they beat this metric? Did they fall short on that metric? And the stock moves around 3, 4, 5% moment to moment. And as you can see, the stock is now up 4%. It was down 4% as soon as that one number came out where they're spending more on AI than was the estimate. So yeah, Scott's got it absolutely right. This is a long-term story, and Meta is managing the business, not the quarterly earnings.
Scott, I was listening to my buddy Josh Brown's podcast last night. Josh, very smart guy like yourself, Scott. He was talking about Meta, and he kind of framed it like this. I'm just interested to get your take. He kind of suggested, Scott, that Meta has had sort of a story problem, a narrative problem. Because again, the stock is popping here, but heading into the print, Scott, it was down about 10% since they last reported in October. I guess Josh's point was, to paraphrase, they seem to have all these balls in the air, and Zuck has seems to have all these sort of side quests. And he was suggesting, Scott, maybe they would benefit if they were just a bit more clear in their AI story and strategy. And I'm just curious what you make of that.
Well, I think that's a valid point, and I think if you do back up 12 months, I mean, and you insert Alphabet in Meta's place and vice versa. The stories were, exactly the opposite, and then Alphabet got much cleaner as the year progressed. And I think with Meta, the beauty of that is they have the ability to now provide clarity around the business. They've defined this kind of expense growth. And then I think you'll see the management team talk, quite a bit about the growth prospects of the business. And you're beginning to see, even right now and after hours, the beginnings of a narrative flip again that begins to favor Meta. And Meta trades, this is not a knock on Alphabet, but it now trades at a 6-turn discount on a multiple basis to Alphabet, despite the fact that it's growing almost 800 basis points faster. So Alphabet's margins aren't declining the way that Meta's are, but there's a heck of a lot of growth here.
So let me ask you, Scott, so you're bullish on the name, like Adam, but when clients ask you, Scott, hey, okay, it's a buy, it's an outperform, but what are the risks I need to think about, over the next 12 months? What do you tell them? What should be on their radar?
So outside of macro, so company specific, I think it would be, that the company begins to spend in areas that don't stimulate growth so that you can't see the benefits of it. And so revenue growth decelerates as they're spending. So the core business is perceived as deteriorating, and the company continues to put its foot on the gas in terms of spend. That's clearly not happening right now. In fact, the opposite is happening. Revenue growth is accelerating. But if that flipped, so the core business started to decelerate meaningfully, that would be notable and it would be problematic for the stock.
Let me ask you, you mentioned Alphabet there, Scott. I'm just curious, any read-throughs from Meta to Alphabet, those earnings on deck, of course?
So the revenue growth healthy, you can't read much in terms of Alphabet's kind of infrastructure, but the vast majority of the business is the advertising, which the advertising industry continues to be strong. I think the primary challenge that Alphabet has is, even though search should beat and the cloud business should beat, the multiple's gone up a lot. Stock's up 60, almost 70% year to date. It's a double off the bottom. And so I think the greatest challenge that Alphabet has now is just valuation, but the underlying business is performing phenomenally well. And I think Meta further validates that on the advertising side.
Scott, as always, we are lucky to have you on the show for that analysis. Thank you, sir.
Thank you, Josh.
AMD fourth quarter earnings just now crossing the wire. Let's get to Yahoo Finance tech editor Dan Howley for the results. Dan, what do you see?
Shares are down more than 5%, but they beat on both the top and bottom line. We saw EPS of $1.53 on revenue of $10.3 billion. That was ahead of expectations of $1.32 and $9.6 billion. We also saw the data center revenue come in at data center revenue came in at $5.4 billion versus expectations of $4.97 billion. They also gave better than expected Q1 revenue outlook. The street was expecting $9.4 billion, but AMD says it'll come in between $9.5 and $10.1 billion. They also penciled in about $100 million of revenue potentially from the sale of their chips to China. So we're still trying to figure out why the street is negative now on AMD's stock price, despite this beat. Could be that it just didn't beat as much as they anticipated or perhaps wanted. This is all part of this ongoing AI trade where, we had saw these huge explosions in numbers. Now they're coming back down to earth, law of large numbers, obviously. And so that means that the growth over time is going to become a little more modest as we go on, but still a big beat here on Q4 and Q1 outlook.
All right, thank you, Dan. Appreciate it. Well, AMD reporting fourth quarter earnings moments ago. Let's get some analyst reaction here with Cody Akery, Managing Director and Senior Semiconductor Research Analyst at Benchmark. Cody, AMD just reported. What do you make of the results, Cody? What explains its reaction? Why are we in the red here in the after hours?
Well, I think it's just a matter of heightened expectations, especially after Intel missed so badly on their outlook, and they were supply constrained. The expectation was that AMD was just going to be killing it on market share gains, and I think they are. I think they're upside on data center by nearly $500 million, and data center shows continued strength in share gains. They're also seeing their client side business up 39% annually, and so they're seeing strength in data centers and in client. So I think they're just really able to take advantage of Intel's weaknesses and the strength of the broader market, with AI leading the way on data centers and client being a relatively healthy space to be as well.
So that client segment, Cody, so that's chips going into laptops, PCs. One question there, and listen, it's not just a question for AMD, but this global memory shortage, Cody, and now people are asking, okay, does that mean PC makers, they're going to have to raise prices? That could dent demand and maybe impact AMD's bottom line. You've heard this. I mean, what's your take on that?
Yeah, there's definitely concerns out there regarding the health of the PC market this year. But like you said, with memory prices impacting consumer activity, and I think that that's a valid issue. I think we'll see stinted demand throughout the year for PC units, but that's well known, and AMD continues to take market share in that space. So I think they continue to grow even in a softer market at the expense of Intel, unfortunately for Intel. But it really is all about the data center, the growth of their Instinct business, their GPUs. And I think that as 26 progresses, AMD starts to pick up momentum as we ramp into their new MI400 series 455 and their Helios rack system in the second half.
So that's where I wanted to go, Cody, with you next, is the products in the pipeline, Cody, the new GPUs, the rack scale server, that's taking direct aim at NVIDIA. How well positioned is Lisa Su's company here with those new products on the way?
I think they're very well positioned. I think in the back half of the year, we'll see the first real viable competition with NVIDIA's Blackwell platform. Now, this is still not behind. It's still a generation behind NVIDIA's most advanced systems, but it's the first viable competitor for a rack system in the industry. And AMD's products are likely to test NVIDIA's market share at a more price-sensitive entry point.
What about other competition, Cody? You think about AMD's own customers. You think about the hyperscalers, the big cloud giants, the Microsofts, the Amazons. What kind of competition could that pose for AMD long term?
Yeah, I think it's a valid argument. Broadcom is the leader in the ASIC industry as they're working with many of the hyperscalers. You're seeing really all of the hyperscalers invest in their own custom ASICs for a portion of their their workloads. It's more of an inference game for ASICs, and AMD and NVIDIA are going to have their place in the industry with high-performance GPUs. I think there's room for both in a capacity-constrained data center environment, but it is an area that we're watching as the ASIC, like you said, AMD's customers are motivated to use their own internal silicon.
Cody, to your very good point, listen, expectations here were high. I mean, heading into this print, this stock had been a rocket ship, right? It was up more than 100% over the past 12 months. Just a remarkable run. I know you got a buy on the name, Cody. I'm sure you get questions, though, about valuation. You still argue, listen, it's attractive at these levels.
Yeah, I do. I think that as we ramp through 26 and they look at success of the launch of their Helios platform and we start to see real customer adoption, remember, they've got Oracle, they've got OpenAI commitments. They have customers that are on board and are committed to using AMD for the for the early generations of their rack scale system. And so I think as the market starts to see the fruition and the evidence of these years of work that they've been putting in to become an NVIDIA competitor starts to play out through 26, the stock will respond nicely.
Let me ask you a question about China. I'm just curious, what do you think the opportunity, not just for an AMD, but more broadly, the names in your coverage universe, what does that opportunity look like long term?
Well, I think that China opening the door, at least tacitly, for NVIDIA and AMD's processors is a positive. It's a nice revenue contribution for Q1. They're saying $100 million. I think that's a drop in the bucket for the broader Chinese demand with Baidu, Tencent, Alibaba, and ByteDance all looking to buy processors. So I do think that Chinese activity is going to increase as the year progresses, and AMD will be a viable player in that market. AMD is obviously still playing catch up a bit in that business to NVIDIA, but I think that as the year progresses, their momentum will build.
Final question, Cody. You got buys here on AMD and NVIDIA. But if I pushed you, Cody, would you say, listen, one of these is more of a buy? It's a strong buy.
Yeah, I think the rate of change with AMD is higher than what we'll see with NVIDIA. NVIDIA is fending off competitors like AMD and the ASICs from Broadcom, whereas AMD is really coming up from a minimal market share. I see AMD in their competition against NVIDIA very similar to what I saw with their competition against Intel a decade ago, where they came from nearly zero market share in the server industry to today, where they're nearly half of that business. Now, they benefited from Intel's mistakes, and I don't expect them to get the same hand up from NVIDIA that they saw from Intel. But I do expect AMD to be the share gainer in the space, and therefore its rate of change it will be more significant than NVIDIA's.
Cody, as always, great to have you on the show.
Thanks for having me, Josh.
Palantir, fourth quarter earnings just now crossing the wire. Let's get you those results. Q4 EPS 25 cents versus expectations of 23 cents, and revenue up 70% to 1.41 billion. So those are beats on the bottom and the top there. Segment revenue, U.S. government, 570 million. That's a beat. U.S. commercial, that's up 137% to 507 million. So that is also a beat. Turning to the guide, Q1, they're calling for adjusted operating income between 870 and 874 million. That's a beat. Revenue, they're calling for between 1.532 and 1.536 billion. That also beats consensus. Now, for the full year, Palantir saying they're looking for adjusted operating income between 4.126 and 4.142 billion. That's a beat. And the revenue forecast easily beats consensus. They're calling for between 7.182 and 7.198 billion. And the street was closer to 6.27 billion. No surprise, the stock is up right now. You know, heading into this print, the stock was up around 80% over the past 12 months, but it was down about 15% this year. It was down about 30% from its all-time high back in November. And analysts who cover Palantir chalking that up to, in part, they say Palantir was just not immune from the broader sell-off we had been seeing in the software sector, but at least the initial reaction here, very positive. We're surging 6% in the after hours. I did have the chance to catch up with Palantir CEO Alex Karp. We talked about the quarter. Here's his summary. He says, the people focused on the market don't understand how it works on the front line, on the battlefield, or in very complex businesses. We have this thing that actually unlocks the underlying value of AI. That's how you get these numbers. I also asked Karp about risks that AI could at one day long-term disrupt his own business. Karp telling me, in tech, you only have a time horizon of a couple years. You can't say you will never be disrupted. That's why you have to be alert. But we have made investments in this tech years ago, all of which we thought would be valuable. Honestly, Karp told me, it looks like the products and the culture we have are ideally built for the time we are in now. We are a different species of company. And finally, I did ask Karp about just that broader geopolitical AI competition. What's the state of the kind of chessboard right now? Karp saying, what do you do if you are Western Europe or Canada? How do you explain to your people that you are not participating in this revolution? The only countries, he told me, participating at scale are the US and China, and we have a different problem with China. Do we stay far enough ahead militarily so that we make sure that we set the rules and they don't? Palantir surging right now in the after hours, up nearly 7%. Palantir reporting fourth quarter earnings just moments ago. Let's get some more reaction with Shai Balor, Chief Market Strategist at Futurum. Shai, Palantir just reported, results crossed the wire. We are surging here. We're up about 8% in the after hours. What do you make of the results, Shai?
First and most important, the growth debate is officially over. I mean, I think a lot of the AI bears were bracing for a deceleration in Palantir's 2026 guidance. We actually got a reacceleration. They were embracing for a low 40s. Palantir just guided a 61% growth for 2026. So that is the single most important data point in this release, in my opinion, because it's showing that growth is continuing to reaccelerate off an already massive base. And that alone validates the peak growth narrative that drove the drawdown to earnings, especially when the market is just so risk off on anything dealing with software. But this print alone proved that Palantir is not enterprise software. They truly are infrastructure. And more importantly, this isn't coming from one-off contracts or just any kind of single vertical. It's their whole business. Their U.S. commercial revenue went up 137% year over year, and they guided to over 115% growth next year. So that tells me demand is broad, it's repeatable, and we're still very early in what Palantir's commercial build-out is going to be.
On that commercial build-out, I'm glad you picked up on that. So U.S. commercial, 137%. It's up to 507 million. That was an easy beat. I mean, the analysts had penciled in 479. What is Palantir's secret sauce here, Shai? What are they doing different?
They're essentially walking into these rooms, asking their customers, what do you want AI to do for you? And then they actually do them. They're not just an AI wrapper centered around someone else's data. They're not just some kind of marketing slogan that they're using instead of being SaaS, now they're AI. Like, this is truly what can AI do for you, and we will accomplish that for you. And I think that right now it's safe to say commercial momentum right now in Palantir is becoming the core story. It's not just a government business anymore. Government remains strong, clearly. I'm not saying that's going away, but the center of gravity has clearly shifted. I mean, the commercial TCV, the commercial growth, they're all exploding at once. And that tells me that there's deeper deployments, there's faster expansions, and these customers are seeing what ontology can provide now. So I think the past 2 years were kind of proof of technology for Palantir. Now, I think the customers are like willing to trust what they're selling and just let it run, especially when agentic AI hasn't even started yet. We just saw this past month the ability of what AI agents can offer now. We're at that phase of the AI cycle with Claude and the Claude Code. Now, once that scales, that's another leg for the Palantir commercial business. And I think that they already did all the legwork to get that trust from these customers. Now, as agentic AI really takes off, they're more willing to explore deeper deployments. And I just think that this partner-driven flywheel that Palantir has now is just really super early. If you think about the TAM opportunity, it's nobody's making more money in AI other than Jensen and NVIDIA than Palantir, and you're showing more proof of that.
Shai, we have seen, to your point, this sort of broader sell-off in software, right, which has been rough. I mean, Microsoft, Salesforce, ServiceNow, Adobe. I mean, investors seem to have said, listen, we think AI is playing out in chips. We think it's playing out in Meta, but they clearly have steered clear of software. One, I'm just curious what you make about that trend and theme. And two, whether you think you look at these results and say, okay, but there are some names like Palantir that seem to be separated, that stand apart.
Yeah, I think there's a nuance now investing in AI applications. There used to be a time where a lot of the revenue is going to be was pretty predictable based on the contract length, the business model itself. You create one code and then you launch it repeatedly at a very high margin. I think now we're seeing signs where a lot of these software companies are losing value because AI is automating a lot of work that's causing their application to become more and more of a commodity. It makes their product a lot less unique. The difference between Palantir, clearly, after this report, is like Palantir gains value when AI shows up because it's the system companies actually run to have AI inside their business. So that essentially is going away from a company saying, like, we just added AI to a company saying, this is how AI makes real decisions in the real world. I do believe that we're in the lazy part or the fluid part of the market where anything SaaS related or adjacent is just getting taken down blindly. That will change eventually, because even if I do believe agentic AI is going to take off, that's going to create dozens, hundreds, thousands of more digital products into the world. What do you have to do with those products? You have to protect it. That's the amount of data that's going to get generated, and agentic AI is going to be wild. You're going to need security. That's not going to get taken away at all from AI agents. So, but if you look at the stock market, I mean, CrowdStrike's down, Rubrik's down, Zscaler's down. Across the board, cybersecurity is down. That shows me that the market is just punishing these companies first, then asking the tough questions later. That will change. Maybe this this cycle that's going to happen, but I don't think it's going to be a quick flip of a switch. All of a sudden, software is going to be great. I think it's going to be a couple quarters to prove to the market that in this inflection point for AI agents, like the business is not suffering. In some ways, some are expanding. They're going to get rewarded. I mean, I think you're going to see a lot more openness from these software companies on proving what the AI is causing their metrics to show reacceleration this quarter, maybe next quarter, just because that's the only way you can change a narrative. I mean, MongoDB, a lot of people don't talk about MongoDB, but like they're acting pretty well against this SaaS backdrop because they've proven 3 straight quarters of reacceleration in their Atlas business. I think that good enough is not okay anymore in the market's eyes. You need to show a reacceleration to get rewarded by the market, and Palantir is clearly showing that every 3 months, and they're justifying that valuation just because they're in a league of one, especially when the AI tsunami is coming for the whole space. They clearly have the largest boat to survive that tsunami.
So Shai, who would you consider at this point Palantir's competition? Does Alex Karp have rivals, or do you think, Shai, as you said, it's one of one, it's a league of one right now?
Listen, they've had years to come up with the competition. I mean, commercial business is 3 years in, and I haven't seen one. And I just don't think there is one because it's a similar story as NVIDIA in the AI accelerator market. Like, this was not an overnight success story for Jensen and the team. Like, they were working decades and seeing what the AI economy is going to be formed. Karp and team was doing the similar thing. We just got to an inflection point where they're able to scale their commercial business to really change the narrative of government black box. And now they're the operating system of AI. So I do believe that maybe there might be some competing products, but it's going to be very niche. It's not going to be anywhere to scalability as Palantir does, because when you're a customer and you're showing you see the ROI that Palantir can offer, their competitors also see what's happening inside the organization. So they're going to be more willing to trust and adopt it. And Palantir is one of the stickiest offerings out there in enterprise, and you just don't take it out for a 70% good enough product that might save you a couple of dollars, when this truly is giving you all the information you need, providing they're owning the translation layer inside all these large organizations that doesn't matter what AI model wins, Grok, Gemini, ChatGPT, like they are truly the picks and shovels winner of all that best AI model race. And if you're going to invest billions of dollars in these frontier models, like might as well have Palantir infused into your organization, because there's only so much you can do with the information you get from these models. You need to act in the real world, and Palantir's the only way to do so. So I think we're years away from that. And Karp is just he knows this business better than anyone else. And I think he can always stay in front of what the latest and greatest is. And I am excited to see what he's going to do with AI agents once it starts scaling up. Like, this is a once in a lifetime company, and they are proving yet again today.
Shai, appreciate that instant analysis, sir. Thank you.
Thanks for having me.
And let's talk Palantir also, because that's giving investors something to cheer about. The software company forecasts 2026 revenue well above Wall Street expectations, projecting a 61% jump in revenue to about $7.2 billion for the full year. Here to give us his takeaways from the results, Yahoo Finance tech editor Dan Howley. So Dan, it's very interesting at Palantir because for a while it was mostly reliant on government revenue, and the line was that it needed to get more commercial. Seems to have done that.
Yeah, they really have. I said 61% revenue growth projected for 2026. That's year over year versus 2025. But for this quarter, they saw U.S. revenue grow 93% year over year. Commercial revenue was up 137% year over year to about $507 million. And then obviously government revenue was up as well, 66% year over year to $570 million. They also said that they saw revenue grow for this particular quarter 70% year over year to $1.41, give or take, billion. So obviously a very good quarter for Palantir. And it came after, the stock had a big sell-off towards the end of 2025, early 2026, basically since their last earnings report. All around the fear of an AI bubble, whether this is going to succeed. Michael Berry obviously had a note out saying that he had bearish sentiment on it, well, more than bearish sentiment on the company, and that really the big X factor for it, the kind of forward deployed engineers weren't really a long-term kind of sustainable growth pattern for them. But clearly they performed this quarter, and they believe that they're going to continue to perform going forward.
And Alex Karp, of course, always very outspoken on these conference calls. What did he say? It was cosmic something?
The results were like a cosmic reward for investors or something along those lines. Yeah. He likes to pontificate in his notes and his public appearances, and obviously in his kind of reaction here to the numbers. I think one of the big things out of Davos was him basically saying, yeah, I don't know if I necessarily should be doing this, but I'm doing it, going out and talking. He says that employees tell him to stop doing that as much, kind of maybe fade into the background and not be as active out there. He had a kind of big to do at the New York Times Deal Book Summit late last year as well, when he was on stage. So yeah, he likes to make these kind of grandiose statements, but clearly they're backing it up from these results now.
They are. I will say just quickly, I know there's been some internal talk about the company's contract with ICE, especially over the past month or so. Did he talk about that at all?
Yeah, I mean, that's something that has been just an ongoing issue for them. Whether or not their technology should be used by ICE as its own organization. He's backed that up in the past, basically saying that they work with the government. They try to ensure that there's no misuse or anything along those lines. But this has absolutely been something that has come under fire a lot more now, even though it was previously under fire for being used by ICE. So, I think they're going to continue that moving forward.
We've talked about Palantir before. I know it's the valuation conundrum with this one, Gil. But the higher that its profit gets, the marginally better that valuation looks, right?
That's right. They were growing into their valuation even at 50% growth, and then they went to 60% growth, and now they're growing 70%. So they're going to grow into that valuation a lot faster than we thought. That doesn't mean that curmudgeonly old software analysts like us are going to be stuck in our ways and hard to recommend a stock trading at 60 times revenue. But the investors that have bought Palantir over the last couple of years sure are happy right now.
What do you think? How do you think about Palantir's business prospects? I mean, you listen to Alex Karp and you get a very optimistic view of what the growth is going to look like for the foreseeable future for this company. Where do you think sort of the biggest opportunities are still untapped for Palantir?
Well, opportunities abound. Right now, the main opportunity is in the U.S. commercial business. That's the business they just grew 137%. And the reason is very simple. They're going to companies and they're telling the CEO, what's your biggest problem? We can solve it with AI. And CEOs are taking them up on it. These are very big contracts they're signing Palantir to, and Palantir is delivering, which makes selling to other CEOs very easy right now. So that's their biggest opportunity. It's not that they're not growing in US government 66% or growing internationally. They're growing internationally as well. But US commercial, you have so many companies that have spent 3 years trying to figure out how can AI solve my problems. And nobody's been able to do that for them except for Palantir. And it's what Palantir has been building over 20 years is paying off now. Their abilities to take companies' data and organize it well, they call that ontology. Their ability to deploy that with their own people, they call them forward deployed engineers. These are very unique capabilities they've developed over a long period of time. And in the era of AI, that's paying off. And they're able to do something that no other software company can do. That's why they're so successful, and doesn't look like it's going to slow down anytime soon.
Well, and you hit upon something that I really wanted to ask you about, which is sort of Palantir versus everybody else within software. As you well know, most software stocks have had a very rough go of it for really the past at least 6 months, if not longer. Palantir started to get rough towards the end of that period, but it really hasn't traded like its cohort. And do you think that that is justified? Do you think software broadly is going to continue to muddle along even as Palantir continues to grow?
We actually think that software companies are overly maligned right now. They do provide very valuable services to their customers. They're still very good businesses, growing fast, with good margins that can scale well and are hard to switch out of. The software business is still good. We understand concerns about AI. We're in a period of uncertainty. But the answer that includes Palantir is good software companies will execute well as this technology disruption happens and will win. Bad software companies will falter. This is like 30 years ago when we started buying things online. Best Buy and Circuit City were in the same boat. And here we are today. Best Buy is a big, thriving business, and Circuit City's been bankrupt for 25 years. Good software companies will succeed in the era of AI, and there's no better software company than Palantir.
So I guess to oversimplify it, what separates a good software company from a bad software company? Is it just what you talked about earlier, that Palantir comes to a company and says, we can solve your problem, and they actually solve it? And maybe not everyone is doing that to the same degree right now.
That's right. So a good software company is the company that's market leader, that helps their customers solve problems, and importantly, helps their customers adopt a new solution. So I'll give you a couple of examples that were are top of our list right now. Snowflake and Datadog. Snowflake's the leader in data warehouse, data lake type services. You can't do AI unless your data is all in one place. That's Snowflake. Datadog, the leader in observability of applications and infrastructure. You can't deploy AI solutions without keeping an eye on them. It's the leader, and therefore it's also serving the AI natives like OpenAI and Anthropic, et cetera. Companies like that have evolved and are going to continue to evolve well with AI will win. And in fact, they'll win even more than before AI. And so not all software companies are created equal. There are software companies that will fall by the wayside, just like any technology wave. Software life cycles are very short. You either succeed wildly or you get bought by private equity. There's really very few companies that have just been around for a long time. And so the good companies will do well, but there will be victims just like any other technology disruption.
Gil, while I have you, I do want to ask you about a couple of companies that report still this week. That's Amazon and Alphabet. Speaking of companies whose fortunes have diverged over the past year, you can look at these stock prices. Alphabet's up something like 70%, and Amazon hasn't done much of anything. Does that mean the bar is lower for Amazon, or does it still have a lot to prove here to investors?
Yeah, the bar is lower. No, good news for Amazon. The fourth quarter was good for the consumer. And they, in their retail business, they've been able to adapt well to tariffs and other challenges. So the retail business should do well. Margins should be strong because of how much automation and how much they've invested in their logistics and shipping to reduce costs there. And then on the AWS side, they're growing slower than Google Cloud and Azure, but they do have an opportunity to accelerate as they deploy more compute for Anthropic. So yes, there's been the laggard, but there's reason to think that if they do better, they'll get more credit for the fact that AWS is still the biggest hyperscaler. It's substantially bigger than Azure and even bigger lead over Google Cloud. So they still have the opportunity to grow in this market, and Anthropic should be helping them right now as they deploy more compute capacity for them.
And Gil, what does Alphabet need to say to keep the party going?
Yeah, so Alphabet's in good shape in the sense that Microsoft Azure's success probably means that Google Cloud is accelerated as well. Meta's success in selling ads probably means that Google advertising businesses around search, YouTube, et cetera, should accelerate. So they're in good shape. Expectations are very high. The multiple in the high 20s is about 10 points higher than it was just 3 or 4 months ago. So expectations are high for Google to win and dominate AI. That may be a little ambitious, but this quarter should be good because their two most important businesses should either stay at nice levels of growth or maybe even accelerate.
Gil, great to see you as always. Thanks so much.
Thank you.
Tom, are you a buyer or seller on Palantir? Giant quarter. I still think the stock is misunderstood because nobody's reading the financial statements.
Misunderstood in what way? Well, let me say
No,
this.
they just think it's hype, Tom. They just think, Palantir, it's hype. There's no fundamentals behind it. This company's crushing it.
Look, the fundamentals are the fundamentals. Their revenues are up 70% year on year. The adjusted EPS is up 79%. Their guidance, they're guiding for 7.2 billion in revenues in 2026, which will be up 61%. So all that is great news, but price is what you pay, value is what you get. So if all that stuff happens, you're still paying 100 times free cash flow. You're still paying 158 times forward multiple. And you could say, okay, this time's different. It's going to continue to grow, and therefore the super high multiple is justified. And I would say maybe that's true. But if they miss by 1 or 2%, the stock, doesn't go down 10%. It goes down, like silver went down on Friday, chasing shiny objects. Look, I hope it absolutely works for them. But at these valuations, you have very little margin of safety. And there was a great company like this about 25 years ago. The name was called Amazon.com in 2000, and they promised all these crazy things. We're going to be the store of everything. We're going to deliver to your house. We're going to get into the computer business, blah, 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 blah. They did all of that and more beyond what they promised in 2000. The problem was in the interim, you had this little 90% drawdown because you were already paying for 30 years of great execution all up front in 2000, and it corrected. They delivered everything they said they were going to do, and 15 years later, the stock was at new all-time highs. So, you could have a situation like that, or you could have a tree that grows to the sky and it continues to deliver and it continues to command the high valuation. And that's something you have at these type of multiples. You gotta know that you're making that bet. And if you're making that bet, just know what you're in and why you're doing it. And it's a momentum trade, not a mathematical trade.
So we were just talking about Palantir, which seems to be almost its own entity within the AI universe. We've got Amazon and Alphabet coming out later this week. But it feels as though after the huge surge last year in spending plans, enthusiasm, that we've entered a different phase in the AI trade. How are you thinking about it now?
I think that's fair because if you look at the last 6 months or so, tech was going sideways. It didn't go anywhere, but there is a huge dispersion underneath the surface. You look at during the same period, the gap between software as a service and semis, it's 60% in performance, the difference between the two. So there is definitely greater differentiation within the AI ecosystem. But more broadly, I would say though, earnings are still quite strong. And because price hasn't gone anywhere, in terms of valuation attractiveness, it has become more attractive, but we just need to be more selective. So, thinking about the infrastructure layer that we favor, look at the likes of the hardware, compute, and chips as kind of the selective sub-themes that we like within AI versus software perhaps a bit less in favor because it's being disrupted a little bit more. But the bigger picture is that, like we in our global outlook talk about how we need to see new revenues being generated to support the significant capex spending commitment that these companies put out there. So it's not just about kind of taking a greater share of the same pie. The pie needs to grow. So over the medium term, we need to see companies, hyperscalers actually kind of thinking vertically, applying AI to other sectors, pharmaceuticals or financial services.
And when you're looking at the tech plays, the various subsectors, so you must be scrutinizing the growth trajectory, but also I'm curious how closely you're looking at balance sheets, if that has changed, or if you think that's something investors really need to focus on, given the enormous spending needs.
That's right. Actually, to your point about this is a slightly different phase in AI, it can be said about kind of the evolution of balance sheet as well, because up until now, a lot of these companies were able to fund their spending from their huge pile of cash, free cash flow. grow, and it has been somewhat really kind of easily kind of taken by markets. But because we're at this point where spending is still happening, and we're talking about similar level of capex for this year compared to last year, but revenue will take some time to come through, and the time gap between the spending and revenue creation means that we're going to need to see more leverage, which is why companies are going into the credit market to issue debt to fund their capex commitment. And this is a bit different because markets then start to scrutinize a little bit more and say, okay, what is your starting point? Can you afford to issue that? If you cannot afford to issue that, maybe you issue equity, which is what we saw in Oracle recently, right? So I think greater scrutiny around the health of the balance sheet is indeed a characteristic of this phase of AI. But the good news is that compared with the 2000, the starting point of these companies are so much healthier. They are issuing debt from position of net cash rather than position of net debt. So it will be a while yet before we look at the balance sheet in aggregate and say this is very worrisome.
Gotcha. The other thing I wanted to ask you about is we tend to speak a lot about the AI trade in the US, but you're a global strategist. And at the same time, we see this trend of more interest in international markets that really started to rise last year, but seems to be persisting. So how are you, how do you think investors should put those two things together? You know, think about the AI trade, but not exclusively in the U.S.
I think there is definitely diffusion and diversification to be considered from an AI implementation perspective. Last year, South Korea equity market almost doubled, and it's because, well, number one, valuation, but number two, also because of the concentration of the AI play in its equity market. You look at Chinese equity market last year with the DeepSeek news, that has certainly also helped kind of support sentiment towards the market. So AI is definitely a global theme, concentrated in the US, but as we think about kind of not just the build out, but also the application layer, this is where international market looks a little bit more interesting compared to before. Even in Europe, I'm based in London, I speak to investors and clients all across Europe and globally as well. In Europe, people complain about, okay, it doesn't have a lot of exposure to AI, is it going to be left behind? But actually sectors, traditional sectors like financial services and healthcare, they are ripe for disruption, and investors are looking forward to kind of thinking about what AI can do to those particularly thought of as traditional sectors in Europe. So globally, there are sectors that can really benefit from application of AI. We're seeing productivity boost coming through on a sector basis, and I think that would drive the next phase of earnings growth.
And you think even in a market like the Kospi, like South Korea, where we've seen all that upside, that there could potentially be more upside from this trend?
Well, if you look at the relative performance of emerging market over developed market, you look at that ratio, yes, it's rallied last year. It rebounded and outperformed developed markets last year, but we're starting from a multi-year, almost a decade of underperformance, right? So here, it's also closely tied to the dollar. If the dollar stays at the current level, maybe even weaken a little bit, that gives the incentive for capitals to perhaps go outside of the US to seek international opportunities. But here I would say really be selective rather than across the board, because at times of transformation driven by AI, it's not a rising tide lifting all boat. It's creating winners, but it's also creating losers. So really thinking about being very selective, which layer of AI do we want to have exposure to?
I also wanted to ask how rates fit into this picture. I mean, that goes back to the balance sheet. It speaks to the willingness to spend of some of these guys. Do you think we're getting 3 cuts here in the U.S. this year, or what's your outlook now that we know Kevin Warsh is going to be in charge of the Fed?
Well, markets are looking at 2, and it's not starting until second half of the year. We think that sounds about right. I would say that, like people look at Kevin Warsh and say, is he dovish? Is he hawkish? We actually think that framing is misplaced, is missing the bigger picture, which is actually how is he going to manage pressure to cut rate in the context of the broader economy and in the context of the broader environment. Here, the good news is that actually labor market is softer than the actual economy. This week we're not going to have the NFP because of the partial shutdown of the government, but the big picture is that we have been in this no firing, no hiring stasis in the US labor market for a while, and one of the Fed's mandate is maximum employment. So if the labor market is somewhat soft compared to before, it gives them the macro cover to cut rate without it being like a huge political debate. And here the combination of actually the economy seemingly stronger than the labor market. You look at yesterday's ISM data, which is stronger than almost all the economists' forecasts. The combination of a strong economy and a slightly softer labor market, and what this means for the Fed, given its maximum employment mandate, together with inflation, of course, actually paints a picture of risk-on environment for assets, because the stronger growth supports earnings, and the rate environment, it's going to be manageable, even though term premium should go higher, and equities are in a good position in this environment.